Neil, we're here on 2.5 minutes from the Fed decision. We're here on TV and radio with our special. Tom mentioned that survey, NFIB survey is shooting up. Bill Dunkelberg over there. Other surveys, Bloomberg Consumer Confidence, UMich, Conference Board. Do these survey measures, just the feeling that people are more happy, does that bleed into the real economy, just pure, we're feeling good?
Well, it sure beats feeling bad. But, you know, I want to go back to the dots for a moment, if I may.
Please.
We've got dots today that are coming from a group of people. We will have dots next year that are coming from a lot of the same people, but you got 2 vacancies that presumably the Trump administration will fill quickly. And then in 2018, the issues of who's making the dots at the chair and the vice chair level.
Okay, we're going to stay with Dr. Saw. Tom Purcell, thank you so much. I know you've got to get back to your RBC Capital Markets clients this morning. Tom Purcell with great work on wages. Dr. Saw, to bring up the dots here, the vice chairman of Credit Suisse with us, without question, someone who really led through the crisis with smart, thoughtful research on where this Fed is. The vigilantes have joined the Fed for 2017. Are those dots farther out, in the middle of the chart, 18? 19, and the dreaded longer term, are they going to migrate today as well?
I would share the view that was just expressed, that today might not be the day to do that. But once you start to see the policies come into play, if the judgment is that that makes for more GDP,
right,
then at the very least, the trajectory of getting to the long run, that cyclical lift towards the structural level, has to be faster. And you may want to raise the structural as well. And that's not, I don't think that's happening today. Might, but more likely in the course of next year.
All right, Neil Stoss of Credit Suisse. Peter Fisher, you'll recall, Joe of Dartmouth was telling us that the Fed's uncertainty should increase and members' ranges will widen out as well. So we see more of a dispersion.
Right, the dispersion of the dots, not just the median dots, going to be another thing we want to look at.
All right, let's get you a data check here as we count you down to the Fed decision. Taking a look at the Dow, of course, my metric of the day there, we're about 75 points away from 20,000, so marginally higher by 15 points. Dollar yen has moved in a pretty tight range this week, really, as we await that Fed decision, and the 10-year yield around 2.44%. Mike McKee, please.
No surprise, the target range for federal funds moves up a 1/4 percentage point to a range between 50 and 75 basis points. That decision unanimous. But the real news is movement in the dot plot. The median projected appropriate policy path next year, as they say it, is 1.4%, which would mean 3 rate hikes in 2017, not 2. They still expect 3 in 2018 and 3 in 2019, which means the terminal rate moves up to 3% from 2.9. The statement makes no mention of any anticipated fiscal policy coming from a Trump administration. It notes that job gains have, quote, been solid in recent months, and their forecast for the unemployment rate moves down a tick to 4.5% next year. Inflation has increased since earlier this year, the statement says, and, quote, market-based measures of inflation compensation have moved up considerably. But officials' inflation's forecasts have not. They get 1.9% PCE headline next year, getting to 2% by 2018. The rest of the statement is little changed. Near-term risks to the economic outlook still, quote, appear roughly balanced. Growth moves up a skosh for next year to 2.1% from 2%. But the official view, even with 3 rate moves next year, is that economic conditions will warrant, as they have said before, only gradual increases in the Fed funds rate. Gentlemen and lady, discuss.
Okay, right now, the 2-year yield, Michael McKee, we get a reflation jump, and we are substantially off the ugliness of November 8. The blue circle down there is a Trump election. The market goes the wrong way. And then, Joe, as you know, we turned around with a vengeance. Up we go with a new leg up. Mike, you've got a good look at this. Is this, in sum, a further signal of reflation this morning?
Well, it certainly seems that way. The fact that there is no mention of any fiscal policy means probably that those who have moved their dots do so on the basis of the economy they see now. And we saw a significant move up. Jim Bullard probably, we don't know for sure whose dot it is, but only one left their dot unchanged at the bottom of the range. We're assuming it's Mr. Bullard of St. Louis. The rest of them moved their dots up, although a couple came down for next year. The median itself moves up, but there are a few people who think who were looking for more rate rate increases next year, who now think we'll get less. But overall, we've moved from 2 to 3, probably on the basis of the fact that the unemployment rate has come down so fast. And there is an interesting note in the statement today. When they talk about keeping rates low, they say that will provide for some further strengthening. They had said it would provide for further strengthening of the labor market, but adding the word some suggests they don't see a whole lot more room for improvement.
All right, still with us is Neil Soss of Credit Suisse, and joining us now as well is Nomura Securities Head of America's Fixed Income Strategy, George Goncalves. And, of course, Mike McKee still with us from the Federal Reserve in Washington. We are on Bloomberg Television and radio. Let me start with you, George, in terms of the litany of things that the Fed did and didn't do. What was your biggest takeaway and how it affects rates?
So I think, actually the surprise is the dots actually went up, at least for 2017. Most forecasters, including ourselves, were expecting an unchanged kind of projection for 2 hikes per year next year. Now we're having 3. But in actuality, what this really does is bring them back to June of this year. I mean, if you remember, September was the last time they lowered the dots. This is the first time they're actually raising dots really since, I guess, 2014, heading into the preparation for the actual start of the hiking cycle. So I guess the biggest takeaway would be that they're kind of tilting around. And I think Mike's point is a well-taken point, that they're reacting to the momentum that the economy has had, which has been happening alongside with this kind of Trump phenomenon.
The dots spread out and they change. That dot chart, folks, is very, very different than what it was 15 minutes ago. Are there mental tipping points for you as you grind through full faith and credit debt every day? Is there a tipping point to the 10-year yield where it jumps to a new measurement of reflation? We hit 2.50. Is there some critical yield that signals something important to you?
I mean, I think we're flirting with those levels. I think the market has largely adjusted in terms of long-term rates. I think the fact that the front end is reacting and we're seeing some sort of a bear flattening type move makes a lot of sense. I think for 10-year rates to really start to head higher, although the long-run dot did kind of ease, kind of also rise slightly towards 3%, we would need to see 10-year rates north of 265 to really get nervous about.
265, there's the number. See how he got to that? It took him a long time to get there.
He got there.
But he didn't want to really tell me that, but it's 265. I like that.
So we also have with us, of course, Neil Soss of Credit Suisse. Neil, you were saying earlier that the makeup, the composition of the Fed changes next year. There's 2 governors' positions that still need to be filled, and of course, a bunch of voting members become non-voting members, and new members will be coming in. So does it really matter that the dots moved up a little bit, or are they dispersed?
Well, not all dots are created equal. Obviously, voting members' dots matter more than non-voting members.
We don't know whose they are,
point of view. We don't know whose they are. I think the structure of the Fed is such that the chair's views get more deference, if you will, than those of any other individual member. We don't know particularly where Chair Yellen's dot was. Maybe we'll find out hints, at least, of that during the press conference. But I do think it's suggestive of this dispersion argument that was raised earlier. Mm-hmm. It's not so much that the median dot moved up. I mean, that's important enough from a market participant's point of view. But I think what it tells you about the Fed is that this is an unusually uncertain moment for them. There's more dispersion in their perspectives looking out.
Let's look at the data right now, really sum it up. We've been showing you some of the good charts with gold there down. On radio, gold down nicely, and with the Dow getting the scarlet flu lift as she tries for 20,000, 19,930. That would be really worth watching as people digest what has been done with the dots. I'm sorry, the dots are complicated, and you don't get it in 32 seconds for market participants worldwide. The yield is higher. That red should be green. 0.02 is 2 basis points up. So we've gone from a negative 3 basis points to positive 2. I'm going to call it a 5 basis point swing on the 10-year to 2.49%. You just heard Mr. Goncalves talk about 265 is being screened. Tanya, let's celebrate and go to the second screen, if you would. The idea of 1.21% is a huge move in the 2-year yield off of what we've seen. Euro-dollar 106 goes down to 105.82. Dr. Soss, help me here with foreign exchange. I mean, we look at this, and I know, Scarlett, you want to go to Michael McKee, but Neil Soss, help me with dollar strength coming off of the little bit we've gleaned so far.
Well, I think all else equal, if the U.S. is going to be raising rates, while there's a reasonable expectation that Europe and Japan will be sitting on their hands, That's supposed to make the dollar go up, and indeed that seems to be.
Have you ever seen the Atlantic Ocean this wide? The separation between our economic relative success and everyone else is remarkable, isn't it?
Well, it's not. Success it has to do with sort of the motion. I think a lot of what's at issue in Europe is level. They are where we were 5 or 6 years ago. Unemployment very high, but beginning to come down. The early symptoms of a business pickup. With luck, they'll get lots of it. So our stage of economic in the economic cycle leads us to be looking for higher interest rates here in the States, apparently. Their stage leads them to be on hold, or if things go wrong, another round of easing, as we were 5 years ago.
Mike McKee, who's still at the Fed. Mike, you had mentioned that inflation has increased. That was contained within the statement by the FOMC. Tell us a little bit about this increased expectation of inflation.
Well, it's a slight change in the wording, and if you went out to Trump country, they might look at us like we have our heads screwed on backwards when we parse the statement this closely. But in November, they said inflation had moved up somewhat. They dropped the word somewhat, a slightly stronger formulation that suggests they have a little more confidence. We don't know necessarily why. Perhaps Janet Yellen will explain, but we have seen energy prices move higher, and they have continued to attribute low inflation below their target to, in part, the effect of the lower energy prices of the last couple of years. And it may be that they are anticipating from the low unemployment rate that wages will start to rise and drive some inflation as well. So at this point, inflation is probably, especially if we do start talking about fiscal stimulus next year, going to be the key indicator for the Fed now that they've gotten unemployment as low as it is.
George Goncalves, there's a line in the statement that struck out to me. It says, the stance of monetary policy remains accommodative, thereby supporting some further strengthening in labor market conditions. Is there more to strengthen in the labor market that we're not seeing?
That's a great question. I think it's part of the reason why you can also address or attribute the Trump effect. And many folks are just disenfranchised in the labor market, and they're not really feeling like they participated in the full recovery. And wages have been trickling up, but they haven't really trickled up as much as we should have. So I think the underemployed and those that can come back into the marketplace, I think those are the people that that they're looking towards to helping out.
So could it be that Trump and Yellen end up being on the same side of this fight? People expecting some tension, but Yellen also seeing what Trump sees, a number of people out there that could still come back in?
I think an accommodative Fed is what all these policies that are being suggested to be put in place are needed, at least for the first 6 months to a year.
All right, I remain on Dow Watch here, and the Dow actually did get within 15 points of 20,000. So the high for the day was 19,900.
We're not leaving the air until you get Dow 20,000, right?
Yeah, I'm still waiting for it. Okay, Mike, you have noticed something else in the statement you want to bring our attention to.
Well, I mentioned this earlier, but I want to point out to Joe and George that the line about adding something to the labor market, strengthening in the labor market, is something that they have had in the statement for some time, but they have changed that and added the word some. So what they're really saying here is there isn't much more room for improvement in the labor market. They can get a little bit more out of it, but they're pretty much done. And that squares with their new forecast for 4.5% unemployment, down a tick from 4.6% in September.
I think, and Michael, we had a jargon alert here earlier. George Goncalves of Nomura mentioned a bear flattener. Let's expand on this. George, bring up the 2-10 spread, which is a vanilla spread, the difference in yield between the 10-year and the 2-year, high, steep curves, and then down we go. The red box is what happens when things go bad. George, help me here with a bear flattener. Am I right? 2-year yields migrate higher while the 10-year yield comes in?
Or the 10-year can stay where it is. I mean, I wouldn't necessarily say it's bad that you get a flatter curve. I mean, it's really a culmination of the end of a Fed cycle, really, more than anything else. And so, the flats that we saw in 2006, really at the end of the Fed hiking cycle, given how much flattening we've seen so far, does argue, at least in our opinion, that this cycle will not be.
Where's neutral? Where is neutral quickly here? I mean, we're ultra accommodative. We're moving away from that. How far are we from neutral? 3 hikes? Like the banners say?
Look, the neutral rate, by definition of how the Fed's been operating, and which it's a moving target, by the way, is somewhere around 2%, 2.25%, maybe 2.50. I mean, their long-run dots are expecting at least some sort of improvement beyond the 2% level. We, as a house, really think 2% is really the neutral rate. And the question is, can they get there? How fast they get there? and what it does, with all these other fiscal policies that are coming next.
George Concalves with us with Nomura, and Neil Sauce of Credit Suisse. Now we're thrilled to bring in a former governor of the Federal Reserve System, Frederick Mishkin at Columbia University, a terrific textbook that is more than policy-centric. Rick Mishkin, wonderful to have you by telephone this morning on Bloomberg Television and Bloomberg Radio. Your textbook is policy-laden. How will the policies of the Trump administration affect your Federal Reserve System?
Well, I think the key is that we have to realize that there's tremendous uncertainty about his policies. So that affects things in several ways. First of all, that he has indicated that he wants to have much more expansionary fiscal policy, in particular building infrastructure, and wants to cut taxes. Now, the question is going to be what is going to be the actual program and how much is he going to get through Congress. So there's a lot of uncertainty there. But clearly, more expansionary fiscal policy makes it much more likely that inflation will be higher and that interest rates will be higher. So clearly, one of the things that's important in terms of the Fed's operations currently is that their game plan before was that they didn't expect this expansionary fiscal policy. Given that there is now higher probability of that happening, they've actually had to up their estimates of what's going to happen in terms of higher interest rates in the future.
Professor, you and I remember, Neil Sauce certainly remembers, an inflation of a different character. It was the 1960s. Samuelson of the Washington Post has a great book on this. Is this inflation that we're talking about have anything to do with our fears of inflation from another time and place?
I really don't think so. I think, in fact, the biggest problem confronting central banks recently has not been that inflation's likely to be too high, but that it's likely to be too low. We've seen central banks struggle to get inflation higher, and this has been true in both Japan, certainly for a long time, and great disappointment with the changes in monetary policy recently. It's true in Europe, and it's been true in the U.S. I think what we're seeing is that there's now a feeling that it may be easier to get inflation up given more expansionary fiscal policy, and that's what's reflected in terms of events on the ground right now, which is going to affect the Federal Reserve. So I think that the U.S. is actually in a unique position where we may have less of a problem getting inflation higher, but in fact we want to get inflation higher. So it's a completely different environment from the one that we saw in the 1960s, late 1960s, and then in the 70s, where there were real problems in terms of inflation being too high.
Of course, we are 15 minutes away from Janet Yellen's news conference starting, and of course she will make her statement and also take questions from lots of reporters asking her about the impact of Trump's policy on her Federal Reserve. We are, of course, with Rick Mishkin, the former Federal Reserve governor and Columbia University professor as well, and we are on Bloomberg Television and Bloomberg Radio. Rick, I'm glad you brought up Japan because the Bank of Japan made some unexpected moves yesterday, boosting purchases for JGBs maturing in more than 10 years to contain the rise in yields. You mentioned that the problem for these central banks has been to generate some inflation or to get inflation going. We've gone from monetary divergence, that was the theme for 2016, to something more akin to monetary convergence. How does what the Fed does today and does going forward affect what the BOJ, the BOE does in the next couple of months?
Well, I think the issue here is that certainly the Fed potentially tightening a little bit more is something that makes the dollar stronger. Now, from these other countries' viewpoints, that's actually good for their economies, helpful to them in terms of raising inflation, because their goods are now going to be demanded more. The people actually will find them cheaper to buy. So that's actually good news for them, that the U.S. economy has been doing very well, and that actually is something that will help them in the immediate future. We're not in a situation where the dollar. So I think that from this perspective, it's not a big problem for them. It does mean, however, that they still have their central problem, which is how do they change the way people view things in their countries to think that in fact they should spend more and that in fact inflation is going to be higher. That's their central problem.
Rick, we're just over 13 minutes away from the press conference, which, of course, we'll be carrying here live. I expect a lot of questions about politics. But outside of politics, what's the most important information that reporters should try to get out of the Janet Yellen over the next hour?
Well, I think the interesting issue is how much the Fed thinks it might have to modify its game plan. The statement still indicates that the Federal Reserve is going to raise rates gradually, and that's been part of their game plan. And I think that actually is unlikely to change. But on the other hand, at some point, reality may slap you in the face. And if, in fact, fiscal expansion really does take place, and the economy does as well as the stock market thinks it's going to, that may change what the Fed has to do in this current situation. So I think that those are the key things. But I should also mention that the issue of policy uncertainty is a big deal. And so here's where politics does come in. And that could be a drag on the economy. So really, it's going to be very important to see what happens after the inauguration in January, to see how things lay out, whether, in fact, things get very uncertain, whether people start to get very concerned. I think the Fed really wants to wait to see that to see what's happening then to really make a decision as to whether they need to change their game plan or not.
And a shout out here to the reporters and the editors reporting on T-Live Go on the Bloomberg. There were no dissents in today's rate hike decision.
Yeah,
so Esther, George, and Mester voting along with the 25 basis point.
On Bloomberg Radio, on Bloomberg Television, the Fed decides. We're here before the press conference. George Goncalves with us with Nomura. Neil Sass, Vice Chairman of Credit Suisse, of course, with his years of work at the Fed as well. And the former governor of the Federal Reserve System, Rick Mishkin of Columbia University. I want to go to Dr. Sass and Professor Mishkin here on the great idea of the great moderation. What a joy to talk to John Taylor back and forth on social the other day about his work on the Taylor rule. Are we breaking out now? And within the great moderation, Neil Sass, are we at a point where we can just say it's over and there's something new beyond the great moderation?
No, I think it would be premature to say that. The forecast that the Fed put out today, the forecast that by and large the professional community of forecasters is putting out, shows us with 2+% kind of real GDP growth and barely moving up to the inflation target.
Sorry to interrupt you, Neil, but we have photos here. This is a live video. We're listening in here to President-elect Donald Trump in his meeting with tech CEOs. He, of course, is flanked by Mike Pence, his vice president-elect, and Peter Thiel, one of his early supporters in the tech industry.
No formal chain of command around here. I'm honored to have Gary, the president of Goldman Sachs, left Goldman Sachs to do this, and Wilbur. Everybody knows Wilbur. They never call him Wilbur Ross on Wall Street. They just say, oh, it's Wilbur. There's nobody like him. And we're going to do fair trade deals. We're going to make it a lot easier for you to trade across borders because a lot of restrictions, a lot of problems. But I think you'll see. And if you have any ideas on that, that would be great because there are a lot of border restrictions and a lot of border problems. You probably have less of a problem than some companies. Some companies have massive problems. But we're going to solve those problems.
All right, you have been watching a live video of Donald Trump, the president-elect, meeting with tech CEOs in Trump Tower. Of course, this is a long-heralded meeting here between Donald Trump and the tech industry. Joe?
Here's a question that I have. Actually, I'll ask it to you, George. I'm looking at the 2-year and 10-year yields here on my Bloomberg. They're both shooting higher, so no real flattening or anything, or no change in the shape of the curve yet. This is going to sound like a dumb question, but whatever, I'm not afraid to be embarrassed. Why the sensitivity of the 10? What changed in the long-term rate outlook today? I understand why the 2 shot up, because 3 hikes versus 2. Why the 10?
I mean, I think the long-run dots slightly going higher does have some influence on where 10-year rates will kind of stabilize. But I think 10s have been adjusting, and term premium has been rising in reaction to this changing kind of composition of global easing, with ECB elongating its easing program, with Bank of Japan's easing program largely been priced in. It's we're moving away from this world where rates are going to be super anchored by these global forces, and so the U.S. bond market is reacting to inflation expectations, supply considerations. If there is going to be some sort of fiscal impulse, how much debt will we need to finance? All those things are what is being factored into the long-term sector of the curve. Now, the question, that's all fine and good, but at the same time that the bond market's realizing, hey, this is a credible Fed. This is a Fed that actually, even before a Trump administration takes effect, they're actually putting in 3 hikes potentially for next year.
George, I'm glad you bring this up. On Bloomberg Radio and Bloomberg Television, as we wait for Chair Yellen's press conference coming up, Professor Mishkin, I still want to call you Governor Mishkin. Help me here with Fed independence. William McChesney Martin is the one that invented this in 1959. You have always been a staunch defender of Fed independence. We just saw Mr. Trump with some of the economic team, Mr. Ross, Secretary of Commerce, and others, Mr. Cohn of Goldman Sachs, with a bunch of tech guys. I don't know if they're ever going to have a meeting with guys like Rick Mishkin, but what do you think about Fed independence into the first half of next year? Will it be tested?
This is one of my biggest concerns, and this is particularly important in a context where, in fact, we may have much more expansionary fiscal policy. That Trump has made many comments about the Federal Reserve during his campaign, and given his willingness to be very direct and sometimes outrageous on many, many issues, I would expect that he might actually start to comment on exactly what the Fed should do, which is something that we've actually avoided with the last several presidents, which has, I think, been very helpful in terms of the Fed producing better policy. So we actually are in a phase where, in fact, Federal Reserve independence could be compromised, that Donald Trump, I think, has tendencies in that direction. And I think that could be very damaging to inflation expectations, which may make it more likely that inflation expectations could get unhinged in the upward direction. And that could be very dangerous. So we're going to be going through a wild period, not just in terms of Trump on economic policies, but other policies. And the Fed is certainly going to be affected by this.
Professor Mishkin, thank you so much. With Columbia University, Rick Mishkin. Neil Sauce, thank you so much as well. The Vice Chairman of Credit Suisse, and George Congalvis for market analysis here. With a spike up in yields, and Joe, really the markets have reversed, if you will, waiting now for the uncertainty of the press conference.
Yeah, absolutely. I mean, we see the red on the equity indices, not dramatic by any stretch of the imagination, but red. Meanwhile, rates still close to their highs of the day.
I noticed dollar yen back out through 116, still having trouble getting to that weak mark of 120 yen per dollar. Speaking of Fed independence, he has been a staunch defender of the Federal Reserve System. Some would say he invented Richmond economics. That's a certain character and color. And we are honored that Al Brodus can join us most every Fed day. Wonderful to speak to you again, Al. It is an absolutely unique press conference today. Would you recommend to the chair that she not bring up the T word?
I don't know. First, hello, Tom. Good to be back with you. I think she won't need to have that advice. I think she will do everything she can in answering questions to stay out of political issues. Although obviously, I think a lot of the questions that are likely to come from the press will try to probe in that direction, but I don't think she will respond. I think the truth, just quickly in this press conference, the big news is that we're likely to have 3 rather than 2 increases in rates next year. And I think that can be justified on the basis of quite apart from the election and abstracting from what may happen down the road, you already have indication of stronger economic growth, at least some inflationary pressures, and a very low unemployment rate, very tight labor market. So that alone would justify that result. So, people are going to want to know what can we say, if anything, about what's going to happen beyond that. What is the likelihood you may get more than 3? And the truth is she doesn't know, so I think she's just going to have to say that, and that'll be it.
Mr. Brodus, I opened the show this afternoon by mentioning Governor Bernanke's speech in 2003 on reflation as he lectured the Japanese on how to get out of their unique predicament at the time. Is there any risk of how we reflate? Is there a choice set that we have to make as we as a nation reflate so we don't visit the ghosts of the 1960s?
Certainly, we need to be careful. This is a different world. I think really back to the 1970s, Tom. I don't see any kind of near and present danger of anything like that. But we are now moving back in a different direction from where we've been for most of this post-financial crisis era. So they're going to need to be careful. And, of course, the Trump proposals, if they get some momentum and if you see some movement on a tax cut or an infrastructure program, something like that, that's greater than we expect, and it looks like it might move quicker, then they're going to the Fed's going to need to be very attuned to what that might imply for inflation pressures going forward and the possibility that they may come to the fore a little bit sooner than most people now expect.
Yeah, I was just going to ask about that. Could it be that people are really caught off sides at how quickly inflation could come back if we get real fiscal stimulus at a time when we're close to what economists call full employment?
Well, I think there's already sensitivity to that. I think you see it in commentary and probably, at least to some extent, in the markets. But that's the Fed is going to, you don't want to overreact to it. But, the Fed is always saying we need more data, we need another data point. But I think in this case, that's exactly what's needed. They need to watch policy recommendations and how that impacts the economy very carefully going forward. You look at all of the inflation data, and especially the forward-looking inflation data, especially the tip spread and other measures of inflation expectations. You're already seeing a little bit of upward movement there. If that begins to move faster, they're going to need to take that very carefully into account in conducting policy.
In addition to the ramifications of any potential Trump policies, there's going to be a people change at the Fed as Trump starts to fill in his appointments into the empty slots. How tricky will that make Janet Yellen's job? Economic conditions completely aside, the addition of people brought in by this new administration that might potentially come from a different school than she does.
Well, of course, that depends critically on who is in fact brought in. And depending on what the answer to that is, right, she'll have to adjust, and yeah, that'll have an impact to some degree. But keep in mind, she's got a mandate, a dual mandate. She's always very focused on that. She's going to look through personalities and personnel to that mandate, I think, in making her decisions. But sure, that may change the tenor of the discussion. And the atmosphere in the committee meetings. We're
going to come back with Al Broadus, formerly with the Richmond Fed, here in a bit. Joe, let's sum up what we've seen this afternoon. What was the biggest surprise for you? Was it the framing of 3 rate rises off the dots?
No, I don't. I mean, that was a bit of a surprise. It was just an email from Neil Dutta of Renaissance Macro pointing out that for the first time ever in the history of the dots, that long-run dot went up. That really is something that I think
I love that perspective.
And look further at.
And what's great about a guy like Neil Dutta, and there's been others besides Mr. Dutta, these guys were optimistic about the American economy before November 8th.
Before it was cool.
Yeah, before it was cool. And the answer is we have to understand that a certain framework of the people you and I read and talk about every day was way out front of this, and then the election just added to the gas that Dutta was looking.
They've been really consistent on this idea. There is growth, there is inflation at a time when we just heard people say ad nauseum that we were never going to see inflation or wage growth again.
The press conference that we saw last time, let's frame this now. Janet Yellen, chairman of the President's Council of Economic Advisors, ages ago, almost 20 years ago, many years, 8 years or so at the San Francisco Fed, 4 years as vice chair, and now as chairman. I don't think she was prepared for the press conference last time. It was extraordinary. Here is the chair of the Federal Reserve System, Janet Yellen, with a press conference after the election.
Good afternoon. Today, the Federal Open Market Committee decided to raise the target range for the federal funds rate by 1/4 percentage point, bringing it to 1/2 to 3/4%. In doing so, my colleagues and I are recognizing the considerable progress the economy has made toward our dual objectives of maximum employment and price stability. Over the past year, 2.25 million net new jobs have been created, unemployment has fallen further, and inflation has moved closer to our longer-run goal of 2%. We expect the economy will continue to perform well, with the job market strengthening further and inflation rising to 2% over the next couple of years. I'll have more to say about monetary policy shortly, but first I'll review recent economic developments and the outlook. Economic growth has picked up since the middle of the year. Household spending continues to rise at a moderate pace, supported by income gains and by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, despite some stabilization in the energy sector. Overall, we expect the economy will expand at a moderate pace over the next few years. Job gains averaged nearly 180,000 per month over the past 3 months, maintaining the solid pace that we've seen since the beginning of the year. Over the past 7 years, since the depths of the Great Recession, more than 15 million jobs have been added to the U.S. economy. The unemployment rate fell to 4.6% in November, the lowest level since 2007, prior to the recession. Broader measures of labor market slack have also moved lower, and participation in the labor force has been little changed on net for about 2 years now, a further sign of improved conditions in the labor market, given the underlying downward trend in participation stemming largely from the aging of the U.S. population. Looking ahead, we expect that job conditions will strengthen somewhat further. Turning to inflation, the 12-month change in the price index for personal consumption expenditures was nearly 1.5% in October, still short of our 2% objective, but up more than a percentage point from a year earlier. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has risen to 1.75%. As the transitory influences of earlier declines in energy prices and prices of imports continue to fade, and as the job market strengthens further, we expect overall inflation to rise to 2% over the next couple of years. Our inflation outlook rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. Market-based measures of inflation compensation have moved up considerably, but are still low. Survey-based measures of longer-run inflation expectations are, on balance, little changed. Of course, we remain committed to our 2% inflation objective and will continue to carefully monitor actual and expected progress toward this goal. Let me now turn to the economic projections that were submitted for this meeting by committee participants. As always, they conditioned their projections on their own individual views of appropriate monetary policy, which in turn depend on each participant's assessment of the multitude of factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product rises from 1.9% this year to 2.1% in 2017 and stays close to 2% in 2018 and 2019, slightly above its estimated longer-run rate. The median projection for the unemployment rate stands at 4.7% in the fourth quarter of this year. Over the next 3 years, the median unemployment rate runs at 4.5%, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.5% this year and rises to 1.9% next year and 2% in 2018 and 2019. Overall, these economic projections are very similar to those made in September. GDP growth is a touch stronger, the unemployment rate is a shade lower, and inflation beyond this year is unchanged. Returning to monetary policy, the committee judged that a modest increase in the federal funds rate is appropriate in light of the solid progress we have seen toward our goals of maximum employment and 2% inflation. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. With the federal funds rate only modestly below the neutral rate, we continue to expect that gradual increases in the federal funds rate will likely be sufficient to get to a neutral policy stance over the next few years. This view is consistent with participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises to 1.4% at the end of next year, 2.1% at the end of 2018, and 2.9% by the end of 2019. Compared with the projections made in September, the median path for the federal funds rate has been revised up just 1/4 percentage point. Only a few participants altered their estimate of the longer-run normal federal funds rate, although the median edged up to 3%. Of course, the economic outlook is highly uncertain, and participants will adjust their assessments of the appropriate path for the federal funds rate in response to changes to the economic outlook and associated risks. As many observers have noted, changes in fiscal policy or other economic policies could potentially affect the economic outlook. Of course, it is far too early to know how these policies will unfold. Moreover, changes in fiscal policy are only one of the many factors that can influence the outlook and the appropriate course of monetary policy. In making our policy decisions, we will continue, as always, to assess economic conditions relative to our objectives of maximum employment and 2% inflation. As I've noted on previous occasions, policy is not on a preset course. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As our statement says, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Thank you. I'd be happy to take your questions.
Thank you, Madam Chair. Harriet Torrey with the Wall Street Journal. Why does the Fed now see 3 rate increases next year instead of 2? Is it because the economy is at risk of overheating, or is the Fed behind the curve, or is this a reaction to Donald Trump's election?
Well, I would like to emphasize that this is a very modest adjustment in the path of the federal funds rate and involves changes by only, some of the participants. So in thinking about the paths and the revisions, there are a number of factors that were taken into account by participants. The unemployment rate is perhaps a touch, as I said, a touch lower than previously. You've seen some modest downward revisions in that projection. For this year, there was a slight upward revision to inflation. And some of the participants, but not all of the participants, did incorporate some assumption of a change in fiscal policy into their projections. And that may have been a factor that was one of several that occasioned these shifts. But I want to emphasize that the shifts that you see here are really very tiny.
Steve Leisman, CNBC. In recent testimony, you said your advice was for fiscal authorities to increase the productive capacity of the economy. Do individual and business tax cuts increase the productive capacity of the economy? And how would the Fed's reaction be different to fiscal policies that increase the productive capacity of the economy and those that don't?
So the statement that I made that it would be useful to increase the productive capacity of the economy reflects my concern that productivity growth has been very low. It's the ultimate determination of the evolution of living standards. Policies that would improve productivity growth would include policy changes that enhance education, training, workforce development, policies that spur either private or public investment to enhance the quality of capital in the United States that workers have to work with, and policies that spur innovation or competition or the formation of new firms. So tax policies can have that effect. It really depends on the specifics. I don't think there's anything that I could say in general about what tax policy would do, but and I really can't tell you what the Fed's response would be to any policy changes that are put into effect. I wouldn't want to speculate until I were more certain of the details and how they would affect the likely course of the economy.
Can I follow up? I'm sorry, but if there was a rush of fiscal policy that did not increase the productive capacity of the economy, would that mean the Federal Reserve would have to move more quickly with raising rates?
It's something I really just can't generalize about because, while it would be desirable to have tax policies that do increase the productive capacity of the economy, an increase in the pace of productivity change is one of the factors that does affect the economy's neutral rate. A boost to productivity could spur investment. As we've been saying, we estimate that the value of the neutral federal funds rate is quite low, and one of the reasons for that is slow productivity growth. And so it's very hard to generalize about it because it could affect that neutral rate.
Hi, Jim Puzangaro with the LA Times. For the average American, can you explain what the impact of this hike and 3 additional hikes will be next year? And should they feel more confident in the economy now that you are raising rates at a slightly faster pace?
So let me say that our decision to raise rates should certainly be understood as a reflection of the confidence we have in the progress the economy has made and our judgment that that progress will continue, and the economy is proven to be remarkably resilient. So it is a vote of confidence in the economy. As you know, this was a decision that was well anticipated in markets, and I think it will have relatively small effect on market rates. It could boost very slightly some short-term interest rates that could have an effect on borrowing costs that are linked to them. But overall, I think that households and firms will see very modest changes from this decision. But certainly, it's important for households and businesses to understand that my colleagues and I have judged the course of the U.S. economy to be strong, that we're making progress toward our inflation and unemployment goals. We have a strong labor market, and we have a resilient economy.
Sam Fleming from the Financial Times. Clearly, there's been a lot of discussion already about fiscal policy, but even if you discount or don't know what the fiscal outlook is going to be next year, unemployment is already below the longer-run projection. Under the policy rule you cited in your August speech, that would suggest that policy ought to be tighter. Is there a risk that the Federal Reserve is already behind the curve even before any fiscal impact steps in next year? Thanks.
So I would agree that, and as we said in our statement, policy remains accommodative. The degree of accommodation I would characterize as moderate. As I've emphasized and said in the statement, we currently judge the neutral level of the federal funds rate to be pretty low. So there is some accommodation. Remember that inflation is still below our objective. The committee projects, at least the median projection shows, a very modest undershoot of estimates of the longer-run normal rate of unemployment. The median unemployment rate here gets down to 4.5%, which is just a few tenths below the estimated longer-run normal level of the unemployment rate. And we think that that's appropriate because we want inflation to rise to our 2% objective in a timely fashion. So there is not a substantial undershoot of the natural rate of unemployment. We're not seeing evidence in labor markets of very substantial upward pressures on labor that could signify extreme shortages of labor that could propel inflation higher in a very rapid way, and inflation is still operating below our objective. So I do not judge that we are behind the curve. My judgment is that we're in a good path to reaching our objectives, but of course the outlook is uncertain. We recognize that there are many sources of uncertainty affecting the outlook, and we will have to adjust our thinking as things evolve, as conditions evolve, and we learn more about economic policy changes that could affect the outlook.
Jim Tankersley, Washington Post.
Chris.
I'm curious, you and your predecessor had both at times called for more fiscal stimulus to help with the outlook, the growth outlook. And I'm wondering, how much do you judge the economy has capacity for fiscal stimulus right now? It's a version of Steve's question, but I think we're trying to get at how much can happen before we run that risk of overheating?
Well, I believe my predecessor and I called for fiscal stimulus when the unemployment rate was substantially higher than it is now. So with a 4.6% unemployment and a solid labor market, there may be some additional slack in labor markets, but I would judge that the degree of slack has diminished. So I would say at this point that fiscal policy is not obviously needed to provide stimulus to help us get back to full employment. But nevertheless, let me be careful that I am not trying to provide advice to the new administration or to Congress as to what is the appropriate stance of policy. There are many considerations that Congress needs to take account of, and many bases for justifying changing fiscal policy. I've continued to highlight the importance of spurring productivity growth, that I think that would be something that's beneficial for the economy. Of course, it's also important for Congress to take account of the fact that as our population ages, that the debt-to-GDP ratio is projected to rise, and that needs to continue to be taken into account. And so there are many factors that I think should enter into such decisions.
Chris, and then Lindsay.
Thank you. Chris Condon, Bloomberg News. Chair Yellen, you've just spoken about some of the risks, the inflationary risks of running an expansionary fiscal policy. But in October, you were wondering about whether it might be possible to repair some of the damage done to the labor force during the recession by running what you termed a high-pressure economy. So I'm wondering, why couldn't fiscal policy serve the same end in seeking to run a high-pressure economy, hoping to draw more Americans off the sidelines and into the workforce? Is there something necessarily riskier about approaching it from the fiscal side, or perhaps have you become less enthusiastic about the idea of running a high-pressure economy? Thank you.
So I want to be clear that what I said in that speech in Boston is that an important research question is whether or not in an economy with a very strong labor market, there might be changes that took place that permanently raise the labor force participation, training, and other things of the labor force that would be positives for the productive potential of our economy on a long-lasting basis. I never said that I favor running a high-pressure economy, and as you can see in the SEP projections of the participants, and this has long been true not just in this forecast but in earlier ones as well, you see a modest undershooting. The unemployment rate is projected to modestly undershoot for several years, levels that are deemed to be normal in the longer run. That's an appropriate policy purely on the grounds that inflation is running below our objective, and while we don't want to overshoot our 2% objective, we also don't want a persistent undershoot of our 2% objective. And that does involve a labor market that may succeed in attracting more people off the sidelines into the labor market. It's something we will see as we examine experience over the next couple of years. We may adjust our views on this, but I do want to make clear that I have not recommended running a hot economy as some sort of experiment.
Dunsmuir with Reuters. How comfortable are you with possible interference on Fed policy by the incoming president? And I'm talking there about the negative impact his tweets on aerospace companies in the last week have had on their share prices. And do you feel having a president tweeting about individual companies, do you feel that that could begin to distort corporate decision-making?
Well, I'm not going to offer the incoming president advice about how to conduct himself in policy. I'm a strong believer in the independence of the Fed. We have been given the independence by Congress to make decisions about monetary policy in pursuit of our dual mandate objectives of maximum employment and inflation. And that is what I intend to stay focused on. That's what the committee is focused on.
The president-elect has said that overhauling financial regulation is a high priority for him. I'm curious whether the Fed has been asked to provide any advice on how that might be done, and what advice you would provide to the president-elect about how our financial regulatory system should be improved.
So our staff have been in touch with the Trump transition team, and we, of course, share the objective that the whole government has to work constructively to ensure a smooth transition. I've not been in touch beyond that, and it's not something that I would expect. I'm sorry, so would I about how the financial rate? Yeah. So, okay, on financial regulation. I feel that we lived through a devastating financial crisis that took a huge toll on our economy. And most members of Congress and the public came away from that experience feeling that it was important to take a set of steps that would result in a safer and stronger financial system. And I feel that we have done that. That has been our mission since the financial crisis for the last 6 or 7 years. That's what Dodd-Frank was designed to do. I think it's very important that we have reduced the odds that a systemically important firm could fail by requiring higher capital, higher liquidity, by performing stress tests that provide us another way of ensuring that the firms we count on to supply credit to households and businesses would be able to go on doing that even in the face of a severely adverse shock. The firms, the largest firms, have a great deal more capital than they did before the crisis. Those are important changes. We have placed the toughest regulations on those firms that are systemically important. I would advise that, and we have been trying to do this, that it's important to look for ways to relieve regulatory burden on community banks and smaller institutions, to tailor regulation so that it's appropriate for the systemic risk profile of the particular institutions. I think there was broad agreement also that we should end too big to fail, and that means not only reducing the odds of the failure of a systemically important institution, but also making sure that should such a firm fail, that it could be resolved in an orderly way. And the living wills process has been about that, and I think we've made considerable progress in making sure that the largest and most systemic firms conduct their businesses in a day-to-day way with some thought about, with important thinking in place about whether or not the way they're conducting their business would aid resolution in the event that they encountered a severe negative shock. So this is progress. I would say it's very important not to roll back. There may be some changes that could be made, and we've suggested a few, like eliminating the burden of compliance with the Volcker rule or incentive compensation regulations for smaller banks, or modestly raising the threshold for banks that are subject to enhanced prudential supervision. But I would urge that it's important to keep this in place.
Marty Krutzinger with the Associated Press. The election of Donald Trump seemed to have spark a major reaction in financial markets. Stock prices at record highs. The dollar has strengthened. Long-term interest rates are higher. Did any of that get discussed in the meeting, and do you feel that it will have any effect, either negative or positive, on things? And also, did you have any broader discussion about Trump's economic plan and what it might do and how the Fed might have to react?
So we did discuss these topics in our meeting today. I would simply summarize by saying that all the FOMC participants recognize that there is considerable uncertainty about how economic policies may change and what effect they will have on the economy. And insofar as that will affect monetary policy, of course we will have to factor those policies along with many other things, including the global environment and oil prices and other matters. We will have to factor that into our outlook and figure out what is an appropriate response. But we're operating under a cloud of uncertainty at the moment, and we have time to wait to see what changes occur and to factor those into our decision-making as we gain greater clarity. You mentioned the market moves. So I see the market moves as implicit forecasts about what impact these policies are likely to have on the economy. The changes, the financial market changes that you described, particularly the increase in stock prices, the increase in longer-term rates, and the strengthening of the dollar, suggest that many market participants anticipate expansionary fiscal policies that would raise interest rates somewhat in the United States relative to abroad and would cause a strengthening in the dollar. But market participants are uncertain too, and I would expect changes in our understanding of what is going to happen to also affect market prices in financial markets as we move forward.
Hi, Nancy Marshall-Genzer with Marketplace. Wondering about Slack. When do you think the slack in the labor market will have worked its way through, so we're no longer talking about it at press conferences and it's not such a big issue?
So this is not something that it's possible to judge precisely. My colleagues write down their best estimates of a normal longer-run unemployment rate. The median stands at 4.8%. So we're close, possibly The unemployment rate right now is ever so slightly below, but in the neighborhood. If we look at larger, broader measures of slack, like the U6 measure that includes involuntary part-time employment and those who are marginally attached to the labor force, they're slightly higher than pre-recession levels, but they've come down considerably. We look at a broad array of indicators of the labor market, and if you look at job openings or the hires rate or the quit rate or difficulty of hiring workers as reported in business surveys, I would say the labor market looks a lot like the way it did before the recession, that we're roughly comparable to 2007 levels when we thought there was a normal amount of slack in the labor market. The labor market was in the vicinity of maximum employment.
Mike, and then we'll go to Peter.
Michael McKee from Bloomberg Television and Radio. Given President-elect Trump's criticism of your low-rate policy during the campaign, like it or not, market participants are going to focus a lot in 2017 on you. You've suggested you will serve out your term, but I'm curious if that statement still holds, if you would like another term as Fed chair, if you would accept another term as Fed chair, and would you stay on the committee if you were not Fed chair?
So I guess the way I think about it is that I was confirmed by the Senate to a 4-year term. The term of the Fed chair was not meant to coincide with that of the president, and there were good reasons for that too. It's part of ensuring the independence of the Fed, and so I do intend to serve out my 4-year term. I haven't made any decision about the future. I recognize I might or might not be reappointed. It's a decision that I don't have to make and don't have thoughts on at this time. And she said, I recognize too that I could stay on as a board member, and that's a decision for another day.
Peter Barnes, Fox Business. Just to follow up on Marty's question about the financial markets, the Dow is about to hit 20,000. It's up substantially since the election on apparently investor optimism about potential the impact of President-elect Trump's policies on the economy and an improving economy. I wonder if you share that optimism, number one, and if not, are we seeing a bout of perhaps irrational exuberance right now, or are you concerned at all about a bubble in equity prices that could create some financial instability in the economy?
So, I really don't want to comment on the level of stock prices. They may have been boosted by expectations about tax policy, possible cuts in corporate tax rates that have been much discussed, or by expectations about growth, possible reductions in downside risk to the economy. But these are things that market participants are trying to view along with the likely paths of interest rates. And I think all of that factors into movements in stock valuations. But I don't want to offer a view as to whether they're appropriate. And
you have mentioned on equity prices, you have talked about whether or not the valuations are still are within historical ranges and norms. Is Dow 20,000 kind of within the historical norms? Are you comfortable with that?
Well, I think rates of return in the stock market relative to remember that the level of interest rates is low, and taking that into account, I believe it's fair to say that they remain within normal ranges.
John Heltman with American Banker. You said that much progress has been made since the crisis in making the banks more secure, more safe, higher liquidity, capital levels, et cetera. Does that feeling extend to the culture of the banks, the way that they run, the way that they operate, and their approach towards towards business. Do you think that more needs to be done there? Do you expect that if there has been improvement, that it will continue to be, that culture will continue to improve in the next administration and the next Congress?
Well, there have been many ways in which there have been compliance failures at large organizations, and you've seen a series of enforcement actions by the banking regulators over a range of practices that suggest some breakdown of compliance or culture, whether it involves violations of sanctions or foreign exchange or LIBOR or other matters. So this is something that we've discussed and emphasized the importance of a culture of compliance, and the board will be undertaking a review. We've already begun this year broadly of compliance and management of compliance risk in the largest corporations. So I think this is something that's important, and the failings that we have seen in a number of institutions suggest there's certainly room for improvement.
Greg Robb from MarketWatch. I'd like to, two questions, if I might, follow up on the question about running the economy hot that you mentioned in your speech up in Boston a couple months ago. You brought it up. Are you now sort of distancing yourself from the idea?
Well, I want to make clear what I said and what I didn't say. One of the things we've learned from our financial crisis and from a series of financial crises in history and around the globe is that very commonly when the economy takes a hit and falls into a recession, that productivity doesn't pick up to pre-recession levels, and that there looks like there is a permanent hit to the path of potential output for the economy, which is called hysteresis. And I raised the question as to whether or not this might operate in the opposite direction as well. We have seen quite a few people who lost their jobs during the Great Recession drop out of the labor force and lose their ties and become discouraged and not re-enter. And I raised a question as to whether or not hysteresis could operate in the opposite direction. And that was a research question for economists to see if there is any evidence, because it could be important in determining policy. But I didn't draw any policy conclusions from that. And as I indicated, I think the path that you see that the committee has laid out in a tentative way that involves a modest degree of undershooting of normal longer-run levels of unemployment, going down to around 4.5%, where it would remain for a couple of years, might provide some insight. So I was not recommending a substantially easier policy in order to test that hypothesis.
My question that I had before that follow-up was, both times you've raised rates in this cycle, the market expectations of a rate hike have been over 50%. The market has, kind of priced it in. Is that a prerequisite going forward? Will that have to happen as you go forward, Todd? It's
not a prerequisite, but we do try to explain our evolving views as clearly as we can. It's important for market participants to have a sense of how we think about the economy and the appropriate path of policy to look at incoming data and to form their own judgments as to whether or not changes in policy would be appropriate. And while it's not a prerequisite, if we're in good sync in terms of explaining what goes into our policy judgments, it's not surprising that it would often be true that moves are well anticipated by the market. As I said, in thinking about today's move, we've indicated that We thought we were making progress on our objectives. We wanted to see some more. I think anyone looking at incoming data can clearly see that we have enjoyed further progress both in the labor market and on inflation, and therefore there are good reasons why the market should have anticipated a move today.
Chair Yellen, Patrick Gillespie with CNN. There's been a lot of discussion about manufacturing jobs and trade. I'm wondering, what do you think are 2 or 3 concrete steps that could be taken to increase manufacturing employment in the United States? And separately, I've asked you about the importance of job training programs, something that you've emphasized. Specifically, what do you think about the worker assistance provided to workers who lose their jobs to trade, both the financial assistance and the worker retraining programs? Are they sufficient?
So I don't want to weigh in. I don't intend to weigh in. I haven't weighed in on either fiscal policy specifics of evaluating policies. I'm not going to weigh in either on the details of particular trade policies. But more generally, I'd say you asked me about manufacturing. There were a lot of manufacturing jobs lost over a long period of time, and particularly during the Great Recession. We've had some recovery in manufacturing employment as the economy's recovered. So to some extent, manufacturing employment depends on the progress of the economy, and we have seen some recovery. Over a long period of time, technological change is something that has been important in reducing manufacturing employment, absolutely, and is a share of jobs in the economy. For decades, the pace of technological change in manufacturing has outstripped that in the economy as a whole. And so manufacturing firms have found it easier to continue producing with reducing their workforces, and that's a change that I would expect to continue. You mentioned worker assistance. So some of the forces that are acting on manufacturing and other sectors, including technological change and globalization, even though most economists would judge the overall consequences of these developments for the economy to be positive, certainly there are groups of workers who were harmed by developments pertaining to globalization and technology. And I think most economists and policymakers recognize that it's important to provide ways for workers who are harmed by these kinds of developments to be retrained for jobs so that they can succeed in the economy. And so, I mean, I would agree, without getting into any particular program and whether it's sufficient, I do think that it's important to recognize there are those who are harmed by these developments, and their concerns, I think, need to be addressed by policymakers, certainly.
Justine Underhill, Yahoo Finance. So the Fed's balance sheet has grown to over $4 trillion. And as the Fed begins removing policy accommodation, under what circumstances would you see the Fed removing or possibly winding down its balance sheet and either letting securities mature or possibly outright selling bonds from the SOMA portfolio?
So we have indicated in our normalization principles that we expect to diminish the size of our portfolio over time, largely by ceasing reinvestments of principal rather than by selling securities. We've indicated that once the process of normalization of the federal funds rate is well underway, we would probably begin to allow our portfolio to run off. We've not yet made any precise decisions about when that will occur. We want to feel that if the economy were to suffer an adverse shock, that we have some scope through traditional means of interest rate cuts to be able to respond to that. Now, there's no mechanical rule about what level of the federal funds rate we might deem appropriate to begin that process. It's not something that only depends on the level of the federal funds rate. It also depends on our judgment of the amount of momentum in the economy and possible concerns about downside risks to the economy. So we've not yet made this decision, but it is something that we have long planned to begin to allow our balance sheet to run off, and then it would take several years, and we would end up, if all goes well, with a substantially smaller balance sheet than we have at present.
Mike Derby from Dow Jones Newswires. I wondered if the unexpected outcome of the election and the sense that a lot of people are really upset with how the economy is performing, despite having aggregate economic statistics that look pretty good, is that causing you in any way to think differently about how you evaluate the economy, like what sort of things you look for to get a sense of what's going on in the economy? Basically, did how things turned out in the election, is it making you think differently about how you evaluate the economy's performance and how it's doing?
Well, I mean, we've long been aware, and I've spoken about previously, disturbing trends in the economy, particularly rising wage inequality, income inequality, and the fact that a significant share of our population hasn't been enjoying significant real wage gains, if any. And so these are long-standing concerns. These are not new phenomenon, but the recession was very severe and probably exacerbated developments that had long been affecting many American workers and households, and I think they are quite disturbing. Now, they're ones that the Fed is not well positioned. I think our policies can affect the general level of economic activity and slack in the labor market, the level, the rate of inflation, which we focus on. But I think it's important for policymakers more broadly to be attentive to these trends and to think about policies that could address them. We have been quite attentive with respect to particular demographic groups in the labor market. Particularly minorities tend to be very badly affected by downturns. We've discussed that. We've been focused on it. It's not just since the election, and are pleased to see that they are enjoying gains. For example, the African-American unemployment rate at this point is now about back to 2007 levels as well. But these are important trends, and I think it's important for policy to address them.
Thanks very much. And that was Fed Chair Janet Yellen speaking in Washington after the Federal Reserve raised interest rates by a quarter point and, to the surprise of many people, changed its forecast for its outlook for where the interest rate trajectory will be in 2017, now pricing in now forecasting 3 rate increases.
And for our audience on Bloomberg Television and Radio, Joe, I was thunderstruck how last meeting was so focused and so supercharged, and this one was a little bit all over the place, but with some real high points within it.
Well, what really struck me is the questions about fiscal policy and Janet Yellen saying she didn't think, I forget the exact term, but was very diplomatic, that it was something not necessarily the right time or not necessarily needed to use fiscal stimulus to get us to full employment. I think that was definitely perceived as hawkish a bit, this idea that Janet Yellen doesn't see much more room on either the monetary policy or the fiscal side to slack. And I think that's why we're seeing red literally everywhere today.
Right. She acknowledged that Fed policymakers, including her predecessor, Ben Bernanke, had pressed for some kind of fiscal action, but that was when the unemployment rate was a lot higher than the current 4.9%.
She had opportunities to be more dovish, and I don't think she took as many of them as might have been expected. If you look within, say, the S&P 500, which is down 0.8%, it's really those bond proxies, the real estate utilities, really getting clobbered today. Tech stocks down, but though information tech is the best performing of the S&P subsectors.
Yeah.
So it really sort of tells the story of what's going on.
Go Tania to the data check right now. It's a really odd data check. As Joe mentioned, the equity markets hammered, down 133 on the Dow. I mean, there it is, the Dow Jones Industrial Average. We had to medicate Scarlett in the middle of the press conference.
Because 20,000 is so much farther away.
Yeah, we were not going to 20,000. The 10-year yield sustains. That should be green. That's 6 basis points higher yields. That is a full 9 or even 10 basis point move today, and we have yen weaker, 115, even a 114, weaker out, rounded up to 117, Joe. So there's a discontinuity here between bonds, foreign exchange, and gold rolling over, and yet they're the equity markets, and you mentioned the utilities as well.
Well, you mentioned the 10-year yield is not only sustained, I mean, the yields are right at their highs of the day. So they immediately perked up on those dots. The fact that we're getting, perhaps 3 hikes next year, if the dots are to be believed. That also the long-term dot was raised for the first time in the history of dots. And then going into the press conference, there were certainly opportunities to talk that back. I have dots go here on the Bloomberg. There were certainly opportunities to sort of mitigate the dots. In fact, sometimes the press conference does have that effect of pushing back a little bit against overreading the dots, but I don't think that really happened this time, and so you see this sort of full-on hawkish reaction.
Go ahead, Scott.
No, I go back to what you were saying about the dollar strengthening. That's something that has been consistent since right after the election, and as we know, in the past, when you had a stronger dollar, that led to tighter financial conditions. Does the Fed start to take that into account in 2017?
Let's go to the gentleman with the shortest question, the shortest answer at the press conference today. Our Michael McKee, rude as always, asked an abrupt question on the future for the chair. Mike, she was brisk, to say the least.
Well, she was prepared for that answer, shall we say. You had to know it was coming, and I'm sure she did. And so the idea that she hasn't made up her mind, and it's not her choice, clearly Fed talking points, and that is to be expected, but at least now we have it on the record. I want to mention something, though, about what you were talking about in terms of the dot plot. Chair Yellen was at pains to suggest that it didn't mean a whole lot that they have now got a median forecast for 3 rate increases next year. It will only marginally affect the overall level of rates, she said, and it does reflect a stronger economy with less slack in it, and that is good news for Americans. They should not be upset. Now, that might have been as well a coded message to the president-elect that the Fed is not just talking about raising rates, but in raising rates, they are giving a vote of confidence to this American economy.
And, of course, lots of people tried to press her on prognosticating what fiscal policy might look like under the new White House and how that would interact with monetary policy. I know she largely, for the most part, punted on every single question, said it was not her place to comment. But did we learn anything from Chair Yellen when it comes to how she will think about monetary policy with this expected boost in fiscal spending?
No, we didn't really. The Fed, as she said, will take into account all incoming data, and they do expect that fiscal policy will have something of an impact on the economy. And she noted that some of the people in making their economic forecasts and in setting their dots took into account the possibility of additional fiscal stimulus. How much, we don't know, and how the Fed would react, we don't know, but she said the Fed is watching this. They're operating, she says, under a cloud of uncertainty now, and until they have more certainty about what the fiscal authorities are going to do, they can't really tell you what the monetary policy reaction will be. One question that wasn't asked, and I sort of regret myself not asking this, was, does this mean the Fed is on hold until we get some clarification? 3 rate increases next year, but we don't know when. 50 to 75 basis points, is that the appropriate setting for an economy that is basically at the Fed's targets in their summary of economic projections? So do we wait 3 months, 6 months until the Fed does something again, or do they come back at it more quickly?
That's a really good question. Also, I want to mention that we talk about the projection for 3 rate increases next year. Carl Riccadonna, the chief economist at Bloomberg Intelligence, points out that, in fact, the median dot among voters, the voting members of the FOMC, is 2.5 hikes next year. So exactly split between the status quo of 2 and the 3 that we keep using as shorthand.
One thing I want to mention, Tim Dewey, who comes on here a lot, economist at University of Oregon, said on Twitter, one thing that that stood out to him, people realizing that they may have read too much into a recent Janet Yellen speech about running a, quote, high-pressure economy recently in Boston. Janet Yellen talking about perhaps more research needed into the benefits of running a hot economy. During her speech today, she suggested that that was just theoretical talk, not necessarily that she favored it. Mike McKee, it did seem like at every opportunity she sort of tamped down the necessity of fiscal stimulus now or a very hot economy. Was that a surprise to you during that last hour?
No, I think her comments on a high-pressure economy were misunderstood by a lot of people. What she was talking about is if you get that, is it good? Is it bad? And that is something that needs to be studied. That's what she said in her Boston speech. A lot of people interpreted that to mean, because of her dovish leanings, that she wanted to run a high-pressure economy. In other words, let inflation get above target for a while to try to bring down unemployment even further. She definitely wanted to back off that today and clarify what her comments actually meant. And she did suggest that, of course, fiscal policy, coming at a time when the economy is near capacity rather than in recession, could bring about some dangers, although she wouldn't go so far as to speculate what those might be.
Michael McKee, thank you so much. From the offices of the Federal Reserve System, this after the Yellen press conference. We'll return with Michael McKee here in a bit. He is with Janus Capital, but far more. He is a bond watcher extraordinaire and also taking it across asset classes as well, and a student of our politics and our economics in Washington, William Gross of Janus. Bill, wonderful to speak to you this afternoon. Let's talk about Chair Yellen and our macroeconomics today. Can we withstand 3 rate increases next year? Our Carl Riccadonna makes clear there's a distinction between voters and non-voters. Do you buy into 3 rate increases?
Well, I do if inflation continues to move higher, because that would mean that the short-term real rate probably didn't increase much, if at all. But, you know, I would doubt the ability of a central bank and the global central bank, the Fed, you know, to raise interest rates 3 times a year for the next several years, because the global economy and even the U.S. economy is is relatively highly levered, and housing will begin to reflect that.
Bill, we're going to rip up the script now. I'm going to go right to the global economy and the market reaction we've seen this afternoon. If I look at Asia DXY, which is the set of Asian currencies ex-Japan, there was a breakdown off of these events today. We see from the election, the blue circle, for those of you on Bloomberg Radio, November 8th, down we go, and there's a new leg down this afternoon. Are the Asian economies, the Malaysian ringgit and the others that are substantially weaker, are they going to begin to tell Chair Yellen what to do next year?
Yeah, I think to some extent that Chair Yellen has to recognize that the Fed is not just a domestic central bank, it's a global central bank. The dollar is the global currency, you know, it has been and will be presumably in the future. And so while she won't speak to it directly, because ultimately, you know, the globe is not her concern, but should be. And so, yeah, the Federal Reserve has to be very cautious in terms of raising interest rates to the extent that it strengthens the dollar and not destroys, but you know, seriously affects emerging economies such as the ones you just mentioned. In addition, Mexico, Brazil, others that have high amounts of dollar-denominated debt that ultimately will be very costly for them as the dollar strengthens.
Bill, I was thunderstruck by the response to Chris Condon, Bloomberg's Chris Condon, on a high-pressure economy and the themes that came up of a hot economy. You've written on this. We are nowhere near a high-pressure economy, are we?
No. And the unemployment rate is not an accurate indicator, and I think the Fed knows that. The Fed knows that there are demographic changes and that, there are many more potential employees in the labor force than are accounted for in terms of the unemployment rate. So, a hot economy for Janet Yellen can't simply be described by a 4.7% unemployment rate. No.
Well, let's go to wage growth if we can. And, of course, we've got that jobs report coming up after the first of the year. We showed this earlier with Tom Porcelli of RBC Capital Markets. Bill Gross, there was wage growth of another time. And we are nowhere near that now, even though we're seeing signs of wage growth. Do you adjust how you invest? Because reflation means higher wages and means a high-pressure labor economy within the U.S.?
Yeah, I think ultimately that's where we're going, although it moves very slowly. And certainly with the Trump election, the advantage for labor is not what it's going to be or what it would have been, I guess, if Clinton had been elected. But, yeah, I think it's shifting in the favor of labor, wages versus profits. And as well, Tom, as short-term interest rates move higher and 5 and 10s move higher, corporate margins will be not seriously affected, but affected more than investors really believe, because much of the increase over the past 5, 10, 15 years in terms of margins has been due to lower and lower interest rates, and now the potential for that reversing, I think, exists.
A couple more questions, Bill, on the greater economy before we turn to the dynamics within your bond world. I look at reflation, and there are three outcomes: a further higher interest rate regime, a jump condition that we've had off of November 8th, and yield stability here, or even an outlier call that we migrate back to a low-yield environment. Which of those three outcomes is the best outcome for Chair Yellen, and for that matter, the best outcome for Bill Gross?
Well, I think a steady, mild climb in terms of, let's say, the 10-year. Now at what are we at 250? I didn't check in the last 5 minutes, but just a gradual upward movement in terms of the forward curve is the best outcome for Janus Unconstrained, and probably the best outcome for markets. And I think that potential is really odds-on because of several factors. One, although today's statement was more hawkish than expected, I think global arbitrage in terms of bonds and in terms of JGBs, now theoretically pinned at 0%, present the opportunity for foreign investors to invest in 10-year Treasury at a pickup of 70 or 80 basis points currency hedged. Right. And so there are limits, I think, to what the U.S. Treasury market can do relative to what the ECB is doing and what the Bank of Japan is doing.
Before we get to the politics, Bill Gross on bonds, are we anywhere near the joy of a bond bear market, too many of them that you've enjoyed? I mean, there we are. Bring up the Bloomberg Barclays Global Total Return Index. Tania, this is a great chart with a great bull run in bonds from 09 up. This is the green arch. For those of you on Bloomberg Radio, I'll put this out on social. But we have rolled over 7% on that global aggregate index, Bill Gross. Are we in or heading towards a bond bear market?
Well, when you combine the effect of higher interest rates and very narrow credit spreads, which could widen at some theoretical point, then you're beginning to see the potential, at least, for a negative sign in front of an annual total return. We haven't seen that yet, have we? Yeah. But as you mentioned, it's been dramatically down in the past month or so because of the higher interest rates. But when you combine higher interest rates with tight credit spreads that can widen out potentially, then, yeah, you've got the potential for a minus sign in front of bonds, although probably not significantly, unless you see a tantrum type of moment that that we've seen a few times.
We've seen that a few times, Bill. You and I know that. Have you adjusted the Janus unconstrained fund? I mean, are you now fully constrained, assuming higher yields, a Yellen or a Trump reflation, and Bill Gross has to adjust and amend your portfolio significantly?
Yeah, the unconstrained fund has the potential to go negative in terms of duration. That was one of the reasons for the genre or the sector's initiation 7 or 8 years ago. And so, you know, some wonder, I guess, in terms of Gross and the unconstrained fund, you know, how it could be doing so well with interest rates rising and bond prices going down. The duration has been 0 or negative, anticipating, you know, just that effect. So, yeah, and an investment manager can play it both ways, right, and look for higher interest rates and benefit from it, as opposed to vice versa with the typical bond aggregate manager.
Bill Gross, you grew up in Ohio. You are now one of the elites of the elites. I thought Richard Cohen's essay in the Washington Post the last few days was absolutely magnificent on the flyover America. You grew up in flyover America. Mr. Trump is constructing a cabinet, and with it, financial elites. Is it a signal of a greater gilded age and a plutocracy, or can he somehow take those elites and reach out to the rest of America?
Well, I think the former. I think you've got it wasn't your point, it was your question, but I think a plutocracy, a Trump plutocracy, is a better odds-on bet than a middle America. I grew up in a town called Middletown, Ohio. They call it Middle Tucky because it was so close to Kentucky. Anyway, it was you know, the embodiment of what you just described, and the reason why Trump was elected. Will his policies favor labor and favor middle and lower, you know, wage Americans? I have my doubts. I think he's focused on corporate profits and the trickle-down type of effect that you know, began with Reagan, but you know, in an era.
Bill, you hate airplanes. We had a meeting today of technology elites, the famous gurus. I believe Mr. Bezos showed up, probably with my Amazon boxes for today. They all showed up at the Trump Tower in New York. Are you going to fly to New York to meet with Mr. Trump with financial elites to explain the linkage of your world into Trump's certitude?
I wish I could. Actually, I've had feelers to, you know, to join that group potentially, but I'm happy in California and running the unconstrained fund. But I would like to. I'd like to sit down with President-elect Trump and basically tell him about a finance-based economy that is dependent upon leverage, and that at some point will not necessarily be productive after the fiscal spending package is is over.
Bill, one final question. So much has changed from press conference to press conference. So much has changed on November 8th. Can you tell our viewers and our listeners, can you tell them that we're all clear of financial repression? Does this reflation, this Trump boom, as some people call it, can we say that we will leave financial repression?
Oh, I don't think so. I mean, the critical question is, what is the appropriate real interest rate in this future theoretically fully employed economy? I don't think we can go back to a 2% real rate, which was the rate that is epitomized by the Taylor rule and the Taylor model. I think we need to stay at 0% real or even negative, which is financial repression. You know, Rogoff and Reinhardt talked about that, and you know, historically it's been more than a 7-year period of time in which investors have to be financially repressed in order to regenerate inflation in a practical economy. So I think repression is still ahead of us.
Bill Gross, you have been most generous of your time. We look forward to speaking to you, well, right after the San Francisco 49ers actually win a game. Bill Gross is with Janice in their unconstrained fund. Mr. Gross, it's fun to go.
You couldn't resist.
Mr. Gross is a die. I mean, I asked him once, can you buy the 49ers and put them out of their misery?
Put a lot of fans out of their misery.
He's had a tough year in the National Football League.
He has. All right. Well, while you're talking to Bill Gross, we've been looking at the equity markets making a bit of a rebound here. If you come inside the Bloomberg, I've charted out what the S&P, Dow, and NASDAQ look like intraday. And it's interesting because, of course, you had the big spike up and then the big leg down following the FOMC announcement and the press conference. But here, we're going to zoom in a little bit here so you can take a better look at what happened since 2 p.m. Pull up our Zoom button, and we've made a comeback here in the last 20 minutes or so. And if in fact maybe Dow 20,000 is still not that far away. I'm going to take a look here at the IMAP, which looks at the sector breakdown here, and technology has actually turned positive. Almost half the members of the tech stocks in the S&P 500 are now gaining. Earlier, Joe, you were pointing out that all 10 sectors in the S&P 500 were flashing red, so no one was advancing. Still, when you look at the laggards here, it is very much the defensive names, utilities, real estate, trusts.
Are we correlated this afternoon, Joe? I mean, look at the 10-year yield break out to a 255.
That's been consistent.
I think we're seeing the reverse of the correlation that we were seeing all year, or through the middle of the summer, of course. For so many days in the beginning part of the summer, we were talking about everything going up at once. Today, it's everything going down at once. Scarlett just pointing out the sectoral breakdowns of the S&P 500 with those bond-like stocks really getting slammed. And, of course, the reason is that U.S. government bonds are getting slammed.
Let me interrupt very quickly. DXY printing 102 is a huge deal.
Yeah.
We've been waiting for that.
And that's been another consistent one. The dollar has just been adding to strength. And I love the chart that you pointed out earlier, ADXY, the Asian Dollar Index, which we don't talk about very often. But, yeah, that's the Bloomberg Dollar Index. It's a more measured balance of the U.S.
Yeah, this is better math. I want to make clear the Bloomberg Dollar Index is way better math.
There's less of an emphasis on the euro here.
Yeah.
And, of course, let's take a look at the 2-year and 10-year yields because they're both shooting up and they're both very close to their highs of the day. 1.26. This is a very big move, particularly on the 2-year. You don't see 10 basis point moves very often on short-term yields, but it really speaks to not only the hike, not only the three hikes expected for next year, but I think a certain level of confidence that maybe the dot should be taken more seriously than in the past.
One more quick chart, as Scarlett Fu mentioned, and on Bloomberg Radio, this is the breakdown of Asia DXY. Scarlett, this is all of Asia except Japan, essentially, in a huge leg down. It'll be interesting to see going over to our Asian coverage to see how they react.
Whether that continues or not. Absolutely.
He is the former vice chairman of the Federal Reserve System, Alan Blinders at Princeton, that barely describes his care of his nation. His book about the crash was exceptionally important, and he joins us this afternoon. Professor Blinder, it is a most unusual time. I thought Chair Yellen delicately danced around the nation's political economics. Do you have concern about the independence of your Federal Reserve System?
I have huge concern. Absolutely. Now, she was exactly right to dance around it. But there are things going on in the Congress. I don't know if they'll pass, but things going on, such as control of the Federal Reserve's budget, which are frightening from the perspective of maintaining Federal Reserve independence.
And it's something that, again, she wouldn't really address, but a lot of people have questioned. I also want to get your thoughts on whether we need the kind of fiscal stimulus that seems to be in the pipeline here. Someone had asked Chair Yellen about this, and she had indicated that she and her predecessor, Ben Bernanke, had pressed for some kind of fiscal stimulus or for that handoff to the fiscal side back when unemployment was a lot higher than the current sub 5% print we have. How much can a fiscal stimulus, infrastructure spending really boost our economy, boost growth, and reduce unemployment at this point?
A little, but I think the main point is that we don't need it now. This is the great irony. For years and years, we needed it. The Fed sort of, I don't want to say shot all its bullets, but most of them, and was practically begging the fiscal side of the House for help, as you just said. The Republicans refused to deliver it. Now that Trump is the president-elect, all of a sudden they're in favor of fiscal stimulus at a time that we don't need it. You know, nobody knows if 4.60 is exactly the full unemployment rate, but we're certainly in the neighborhood of full employment. And the Fed is, of course, moving in the other direction to try to tighten very gingerly, very gradually. It's not looking for help from fiscal stimulus anymore. That was one of the things that Chair Yellen had to dance around in the press conference because she doesn't want to interfere in any way with politics.
So what are the risks then of going ahead with a massive infrastructure spending plan when the economy doesn't really need it at this point?
Yeah. So first of all, I very much doubt that the infrastructure plan is going to be massive. Let's put that aside.
Okay.
What I think may be massive is the tax cutting when the economy doesn't need it anymore. So the same question that you asked applies to massive tax cuts. And I think what it'll do is hasten the Fed's pace of raising interest rates. It's going up. It's nobody is surprised by that. The Fed's mantra for a long time now, and still, has been gradual, 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 gradual. You might hear, depending on what the Congress does in the coming months, this is not the coming days, hear that gradual phrase start getting gradually phased out by the Fed as it concludes it has to move more vigorously.
Professor Blinder, a year ago when the Fed hiked last December, of course, they had 4 dots, and then we ended up getting 1 hike. This time, looking ahead to next year, there are 3 dots seen in the future. Is there a reason to believe that maybe that's more credible this time, that maybe we really will get 3 hikes or something, or 2, or something that's not a complete, fall off the floor?
I believe so, and this is why. The main reason why, or the main reasons, and they're related, why we got 1 hike in 2016 instead of 4 is that the economy is weaker than the Fed thought it would be, and inflation was lower than the Fed thought it would be. They were wrong on the forecast, as were lots of people. If that happens again, I will get a similar sort of disappointment. I think it's unlikely that it will happen again. I think whether it's from infrastructure, as some people think, or from tax cutting, or both, and I haven't even mentioned a defense buildup, if the economy is put on a sugar high by fiscal expansion and the unemployment rate falls beyond where the Fed thinks it's safe, and if inflation goes up rather than stay stable or goes down, then I think that will get the Fed raising interest rates more. To me, the risks of the central forecast, 2 to 3, and the Fed said 3 interest rate hikes, is on the upside. If there's more of this fiscal stimulus, more growth, more inflation than we think, then the Fed will be more aggressive.
Professor Blinder, what do you think are the prospects for faster hiring, just on companies coming out and saying that they're going to hire 25,000 workers in the next 4 years, as IBM did yesterday, to get ahead of what they expect to be a dressing down from Donald Trump, who's currently the president-elect, in terms of doing their part to boost growth and boost the economy?
Look, this is impossible to forecast. I would say history suggests that jawboning of that sort doesn't have a large effect on the economy. Look, he can jawbone Carrier, and maybe they sent 730 fewer jobs, or will send 730 jobs fewer to Mexico, but there are millions of companies in the United States of America, and he can't be jawboning everybody. So, yes, there may be some effect, especially from companies that view themselves for one reason or another to be politically vulnerable, but I wouldn't expect it to be large. Remember the numbers we're talking about. When job creation is going at the rate that it's been, roughly the rate that it's been going, you're seeing net job creation of 2 million-ish per year. That's a big number compared to 730.
As you mentioned, things like jawboning Carrier is really sort of small bore in terms of accomplishing what Trump wants to do. Are there policies that could stem the deindustrialization of parts of this country or actually rebuild the manufacturing base? Or is that just a completely bad goal that anything done towards that will be counterproductive?
It depends what's done. If what's done is trade protectionism, which we hear a lot of, then I think it will be counterproductive. It won't be good for productivity in the United States. It will raise prices to people that can't afford price increases and, in general, slow down adaptation to the next phase of industrialization. But if you talk about research and development, better education, job training, helping people move from a declining sector to an expanding sector, a whole plethora of policies like that, some of which will bring back manufacturing jobs, that's all to the good.
All right, thank you very much. Ellen Blinder, professor at Princeton University and former Federal Reserve Vice Chair.
You are watching and listening to The Fed Decides on Bloomberg Television and Bloomberg Radio. Thank you for joining us for this special coverage. I'm Scarlett Fu here with Tom Keene and Joe Weisenthal. Let's get some final thoughts from the group here as we close out our Fed Decides special. Mike McKee, who's at the Federal Reserve, who sat through Janet Yellen's news conference. Tell us what you're thinking.
Well, Scarlett, the open question now for the markets as attention moves up Constitution Avenue from the Fed to Capitol Hill and the possibility of fiscal policy is, what does the Fed do next, and when do they wait until they get some sort of indication as to what kind of fiscal policy the Congress is going to pass? Janet Yellen was asked about that many times today in her news conference, and she said Fed officials had discussed it at their meeting, but had come to no conclusions. Here's what she said.
We're operating under a cloud of uncertainty at the moment, and we have time to wait to see what changes occur and to factor those into our decision-making as we gain greater clarity.
So we really don't know what it is that the Fed is going to be facing and what the economy is going to get out of it at this point. We could see the Fed move again before we get fiscal policy in place. They are talking about 3 moves next year. Or we could see them have to move more quickly if we get fiscal policy that would be extremely inflationary.
I love that clip you played, Michael McKee, and the idea of greater clarity. What I see here is a chair who is deeply knowledgeable on history, and that the rules don't get made by a new president. The rules don't get made by a GOP House, GOP Senate, GOP White House, and the rules don't get made by the Fed. And I would go back to the British phrase years ago, OBE, where you're overcome by events. And I really would suggest I go to the meetings January 27, March 16, April 27th. Those 3 meetings are OBE. They're going to be overcome by events that we can't even see right now.
And, of course, OBE was really the theme of 2016 because the Fed had projected that there would be 4 rate increases for this year, and there ended up being only 1 because of China, because of Brexit, because of all kinds of other issues.
Right. There's plenty of stuff that could happen and will happen. You
heard her say that today.
Right, and so who kind of cool on the hot economy?
We can do a jargon alert here this late in the program. Let's do that right now. Hysteresis. Olivier Blanchard and Lawrence Summers own the high ground on this in their research from a good 30 years ago. This was a very young Larry Summers long ago. And this is when you're out of a job, you become less and less trainable and rehirable as you're out of the job a long time. The Economic Policy Institute measures missing employees right now. The good news, down from 4 million down to 2.3 million. But this keeps coming up among academics, including, we heard, Professor Blinder.
And it contributes to that labor force participation rate not recovering as well.
Not just perfect. Yeah, absolutely.
So when we look at the dots and how everyone's fixated and reacting to, certainly in the markets, to 3 rate increases for next year. And again, this is the projection from the Federal Reserve. Carl Riccadonna, the chief economist of Bloomberg Intelligence, points out that if you strip out the non-voting members of the Fed, actually the median dot among voting members was 2.5 hikes for 2017. So that's exactly split down the middle between the 2 that have been previously forecast for 2017 and the 3 that now has been rounded. It's been rounded up to. So we're really splitting the difference here. It isn't that big of a change.
Let's dazzle some people. Keep that chart up there, Mike. What I'm going to run through this, and you can see the morphing as the yellow dots, Joe Weisenthal, drive higher.
Yeah, I mean, it's not, as you said, it's not a huge change. It's not a massive sea change, but it is interesting, the move higher both on the short end and the long end. And what really struck out to me in this today, what we learned from the Fed is obviously rates have been rising since the summer. Then they really kicked into higher gear after the election. And at no point in the dots or anything in the press conference did the Fed lean against that in any way? In fact, it just accelerated it. One of the big, really big move on the 2-year, also significant on the 10-year. Both of them at fresh multi-year highs, highest level since the election.
127.14 on the 2-year.
That's a really big move for short-term rates. So I think, people might have looked for something dovish. Yellen has a reputation for dovish as perhaps a reason why this rate move wouldn't continue. But the Fed did not give any particular reason to think that this move in rates can go further.
And I would just quickly, I would say watch Asian markets, what ADXDY did, and, to see ringgit and Philippine peso and the others open up.
Yeah, we'll count on Betty Liu and Yvonne Mann to help us do that in Bloomberg Daybreak Asia later on this evening. We want to thank everyone. Michael McKee reporting from the Federal Reserve. Of course, Tom Keene, who pulled a, 16-hour day today for Fed Day. And Joe Weisenthal and myself, we will be back with What'd You Miss? That wraps up our special coverage of the Federal Reserve announcement. What'd You Miss and the market close is next. Take a look at the major indexes. With less than 4 minutes to go before the close, the Dow down by 117 points.
Only in Jamaica.
Away from the closing bell. What'd you miss? U.S. stocks seeing their worst day since before the presidential election on November 8th, after the Fed finally raised interest rates. I'm Scarlett Foe.
And I'm Joe Weisenthal. Welcome to our viewers who are tuning in live on Twitter. You can watch our closing bell coverage on Twitter every weekday from 4 to 5 p.m. Eastern.
As we've been reporting throughout the afternoon, Federal Reserve officials raised rates for the first time this year. So let's begin with our market minutes. At one point, it did look like the Dow might be on its way to 20,000, but that was quickly that prospect was quickly diminished after stocks moved lower following the Fed's first rate hike this year. The Dow actually losing more than 100 points, and WTI oil dropping almost 4%. So we certainly saw energy stocks taking a leg lower.
Let's take a look at the bond market. I want to start with the 2- and 10-year yields, both of them really shooting higher. but the 10-year sometimes moves like that. That was a very big move there, that 10 basis point move on the 2-year. Really a reflection of not only the increase in 2017 dots, the Fed now looking for 3 hikes as opposed to 2, but perhaps, as Professor Alan Blinder said on the recent show just a little bit ago, perhaps some increased conviction that unlike last year when they saw 4 dots in the year ahead, that maybe this 3 dots will actually happen. So we'll be talking about that more. There you see the intraday 10-year really going out on the highs. You see it shooting up there right at 2 o'clock. And then throughout the press conference, as Janet Yellen sort of passed up opportunities to sound hawkish, so to speak, 10-year yield right there at the highs at 2.58%. And I want to take a much longer-term look at the 2-year yield. This is going back 10 years of 2-year yield. So as you can see, we're still not anywhere close to where we were pre-crisis on short-term rates, but we are at our highest levels since 2009. So creeping up there on the short term.
Creeping up there in the short term. Let's also look at currency. Speaking of creeping, it was a straight shot up, actually, for the U.S. dollar. This is the Bloomberg Dollar Index, and you could see that that leg higher came right after the Fed announcement at 2 p.m. And if you look at the individual pairs, whether it's the euro, whether it's against the yen, whether it's against the pound, you can see dollar strength all around there. Worth pointing out, though, that for the pound, you had UK employment data that came in. It was a sign, perhaps, that there was disappointment in the hard data since the Brexit vote, the first genuine disappointment. That's according to Scotiabank's Alan Clark. So UK employment falling for the first time in more than a year. We're going to keep a close eye on that one, certainly, as we get more data out of the UK.
And on commodities, let's just look at 2 of them. Gold and oil start at the bottom there. Oil falling nearly 4% today, really getting slammed. A lot of the sell-off after that Fed decision. Still, over $50 a barrel on West Texas Intermediate, but not a pretty day for that. And then gold down over 1%, sort of similar with what we saw with Treasuries. Anything safe haven, anything like that getting sold off. So gold down a little bit over 1%.
Those are today's market minutes.
All right, joining us now for a breakdown and discussion on today's Fed decision and comments by Fed Chair Janet Yellen, we have with us Deutsche Bank Securities Chief International Economist Torsten Slok and Andrew Levin, a former special advisor to Fed Chairman Ben Bernanke and then Vice Chair Janet Yellen. Professor Levin, thank you very much for joining us. Start with you. Let's talk dots. 2 things really stood out. One is that we're going to foresee 3 rate hikes next year. And the other is that the long-term dot, for the first time in the history of dots, actually ticked higher. So how significant are these changes in your view?
Well, let me just start by saying that I think Chair Yellen gets a lot of credit for leading this committee. It's a wide, diverse committee, and they had a unanimous decision today. That said, the statement that they issued, they unanimously agreed to, only 8 words changed. Out of 500, they only changed about 8 words, other than the sentence that literally, indicated the funds rate. And so the extent to which there were shifts in the dots for the coming year, and not just the coming year, but the next several years, they were up by about a quarter point in each calendar year. That's why you see the bond markets moving. As you said, the 2-year and the 5 and 10 years moving, and very little explanation from the Fed about what's the underlying reason for that. So the critique, I think, of the Fed's communication, you can see very clearly, it's very clearly illustrated today, that the Fed seems too arbitrary, not systematic, not transparent enough, not explaining clearly enough what its plans are, what its strategy is.
Do you think more explanation, Torsten, would have caused a more gentler reaction in the markets?
Well, it is a very, very difficult challenge for them because the environment is, as she also pointed out several times, highly uncertain. And one thing that she did clarify, which was not helpful for rates, was that she said, well, I never said that I wanted a high-pressure economy, which is also part of communication. She did discuss this from a research perspective, but now she pointed out, I never said that I always want to be dovish. I have never said that I will keep rates low forever. I have basically said this could be something we should be thinking about what the consequences could be, but we will raise rates if needed. So I think the biggest wake-up call for rates investors today was that it's not the case that Yellen is always inherently dovish, as many have been assuming in the market.
And did that surprise you? Was she on the margins more hawkish than you would have guessed during the press conference?
I would definitely say that many conversations since she gave that speech in Boston were certainly around that issue, or she will always be dovish because she will allow a high-pressure economy. But now she clarified very clearly, no, I'm not always dovish if conditions change. And
she wasn't against it, but she just said she wasn't for it.
Exactly, and that's spelling out clearly that she's willing to hike rates if needed, and this was even beyond anything that Mr. Trump might do. I think that's telling you that organically this recovery is already pretty strong.
So this maximum optionality that the Fed seems intent on preserving, Andrew, is actually more hawkish than what investors are accustomed to, because for so many years we will be extraordinarily accommodative no matter what.
Right. I think that what they need to do as soon as possible is start presenting alternative scenarios, because the truth, as you both said, is there's a lot of uncertainty about what might happen to the economy over the next year or two. There are scenarios where fiscal policy becomes substantially more accommodative. There are also ones where it becomes relatively tight. It's not clear what leaders in Congress are willing to do next year. The retail sales report that came out this morning was weak. The core retail sales barely moved. So I think the reason you saw in the morning the bond market actually yields generally dropping was because, and probably the reason they shot up again this afternoon was because people may have been expecting that the Fed made some reference to these questions, very much like what we saw last December. We could be in a situation where just as the Fed is tightening the path that it expects to follow, the economy isn't quite cooperating.
But the economy is very different this December than it was last December.
Well, let's say the unemployment rate is lower now, but part of the reason for that is because there was a number of people who dropped out of the workforce last month. So the improvement in unemployment was not all because of a strong labor market. And I think one of your guests already said this earlier, you know, that Bill Gross, that the unemployment, but the Fed itself knows the unemployment rate is not a sufficient statistic for the labor market.
As Professor Levin pointed out, there is some confusion about ultimately why the dots went up. Several reporters in the press conference tried to get Yellen to talk about the new administration, Trump, fiscal policy. She didn't really say that much. Is it possible, though, that in the sort of synthesis of all the options, including more fiscal policy, that that's part of what's bleeding into the expectations here in the dots?
There was probably a lot of unspoken things at the press conference and at the meeting here that it's a huge uncertain how much fiscal stimulus we will get. But I think the most important point today is that Godot has arrived to the fixed income market after 6 or 7 years of very, very low rates. Rates investors are now realizing, well, actually, the Fed might be hiking rates, and we might now finally see the rate hikes come that we've been waiting for so long.
Godot has arrived to the fixed income.
One, right?
Let's get a banner on that. So, what is the solution to resolving this problem of communication and the dots? You said like there's an inconsistency. What's the next step? How do you get them in line?
Okay, so there's several clear improvements the Fed can make. One of them is the chair should start giving a press conference after every policy meeting. Frankly, if the chair had given a press conference in early November, the same question that came up today about the overheating could have been asked at that point.
And
at that point, 2 weeks after she gave the speech in Boston, she could have explained, no, you're misunderstanding what I was trying to say. Over the coming year or two, there could be rapid changes in the fiscal policy outlook, in the global economy, again, as Bill Gross emphasized. And the Fed needs to be prepared to be more agile than it has been. The Fed, for many, many times, said, well, we're prepared to move at any meeting. But the truth we've seen very clearly is that it's very, very difficult for them to move when there isn't a press conference. And so having a press conference after every meeting would make the Fed more agile.
But next year, in 2017, we get a new change in the FOMC, the voting members. You got a whole bunch of new people coming in as voting members, and some of the ones who had been dissenting actually leave as voting members. So the composition of the Fed will be changing. Some say to a more dovish tilt. So we're looking at the prospect of 3 rate increases. We're hearing from Janet Yellen. You just said Godot has arrived to the bond market. I mean, that's for right now, for the end of 2016. It could be a very different picture in early 2017.
Oh, absolutely. I mean, in feels a lot like the standard deviation of where we're going has gone up dramatically. Either we're going to see a much faster increase in rates, or we could see a number of shocks, both from China, from Europe, from oil prices, that could argue for why the outcome could be much lower rates. So that's why the standard deviation of where the dot plot is going, in other words, of where we are going, there seems also to be very clear that there's a lot of disagreement, including, as you say, Scarlett, on what is the composition of committee, what does the committee actually think about the Trump plan, what do they think about what could be coming or could not be coming. All that suggests that there is still a lot of uncertainty in the outlook. But for today, the clear message is that it was needed to hike rates and to signal that, if anything, they are slightly behind.
All right, sticking with us is Deutsche Bank Securities' Torsten Slok and Andrew Levin, former special advisor to Ben Bernanke and Janet Yellen. This is Bloomberg.
Lisa Parenti. Let's get to the first word news this afternoon. Top names in tech in New York today to meet with President-elect Donald Trump. On their agenda, avoiding policies they think will hurt their companies. Trump tried to reassure his guests, telling them, quote, "I'm here to help you folks do well." The room included Facebook's Sheryl Sandberg, Amazon's Jeff Bezos, and Apple's Tim Cook. Not in attendance, Twitter. Political says it was bounced in retaliation for a campaign emoji fight with Trump's team. Before he takes on the position of Secretary of State, ExxonMobil CEO Rex Tillerson must navigate a thorny ethical path over more than $187 million in unvested stock awards. To avoid a conflict of interest, Tillerson will need to sign off. He'll have to get that from the top U.S. government ethics agency and from ExxonMobil's board of directors, which is known for its hard line on executive compensation. A U.S. military investigation in 2010 found Michael Flynn, the retired general tapped as national security advisor by President-elect Trump, quote, inappropriately shared classified information with foreign military officers in Afghanistan. That is according to records obtained by the Washington Post under the Freedom of Information Act. Flynn has dismissed the case as insignificant and has given few details. Turkish President Erdogan is urging all sides to abide by a ceasefire agreement for the Syrian city of Aleppo, even as the deal rapidly unravels. In televised remarks, Erdogan said the accord is, quote, perhaps the last hope for the innocents. Meanwhile, Iran is congratulating Syria on driving rebels from the city. Iran's parliament speaker says the, quote, mercenary terrorists have been forced to retreat. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Scarlett?
Thank you, Elisa. Back with us now are Deutsche Bank Securities Chief International Economist Torsten Slok, as well as Andrew Levin, a former special advisor to Fed Chairman Ben Bernanke and then Vice Chair Janet Yellen, and now with Dartmouth College. Andrew, let's start with what was not said during the Fed news conference. There are no questions posed to Janet Yellen about international events like China, like Europe. And we know that those were events that kind of overcame the Federal Reserve and derailed the planned increases for this year.
Right. I think that the statement, which repeated the same words they've been using lately, was that the risks are roughly balanced. I think the truth is that there are significant risks to the broader global outlook. Bill Gross mentioned this. Torsten has certainly done lots of work on this, and his colleagues. The question marks about European politics over the coming year are very important, and the question marks about China are very important. And that's why I said I think the 3 dots might turn out to be 3. It might turn out to be 4 or 5, but it could also turn out to be 0 or 1 yet again over the coming year, which is why, again, the Federal Reserve needs to start communicating using alternative scenarios and contingency plans, and not to just focus on a single benchmark outlook the way that it's been doing.
Torsten, it's always hard to know where the risks come from. I mean, this year everyone thought it was going to be Brexit, Trump, Italy. None of those things really mattered to the market. It always seems to come out of nowhere. But if you had to sort of plan ahead and anticipate what could be the most salient risk next year, where are you looking?
Well, I would say the way that the important way to think about this is, what is the market story? And this is really important. What is the narrative that's in the market at the moment? And the narrative clearly is that we're going to get a boost to GDP growth. We might even also get a boost to inflation. And it is as if those risks, as Andy just mentioned, to the downside are just somewhat put aside. We have a lot of risk from China. We worry a lot about the housing market in China. What can it do to financial institutions in China? And what can it therefore do to FX in China? And that risk we worried so much about in January and February, I basically get no questions from clients about that, despite that this risk is still growing in the background. So it's as if the narrative, remember, the narrative cannot be too complicated. The narrative just have a few bullet points. If there are too many sub-points, then you say, well, I don't really understand that. That's just too complex for me. So the narrative is certainly at the moment, the few top stories are that things are good. The Fed today is confirming things are good. So maybe we should just believe in that narrative that things are good. And maybe those risks in Europe and the rest of the world, even oil prices, that's not really a big risk at the moment.
All right. Well, you said early in the last segment, Godot has come to the bond market. You said Yellen's own talk should be a wake-up call for fixed income and rates. Let's say we don't get some huge shock. Where could rates go if this is it?
Yeah, so we have rates going up by the end of next year to 310. That may not sound like a lot. We have, in the meantime, quite a bump on the way where rates go higher than that. But the bottom line is that there is still a fairly significant amount of evidence that the economy is very close to full employment. And we are having core PCE inflation at 1.7. So if you are an FOMC member and you look at that, you would say, I have the dual mandate, which is full employment and inflation at 2. It looks like we need to move higher. And markets have been very, very hesitant in accepting that the Fed would be hiking. But today we got evidence, and that's what I mean by that we are seeing a very new regime here by the Fed actually finally adjusting up their expectations to what rates should do next year.
Okay, so today's 25 basis point rate increase doesn't do a whole lot to the real economy. But if rates go to 310, as Torsten was just saying, Andrew, that will have repercussions, won't it?
Right, and I think that the people should understand that if the 10-year Treasury goes up that high, it's going to slow the housing market. If the 5-year and the 2-year go up as much, that's going to slow auto sales. Mm-hmm. The goal of trying to strengthen manufacturing is going to be much harder in that sort of rate environment. So there's going to be very complex cross-currents over the next couple of years, both for the economy as a whole and the individual sectors.
And as well, we don't know what 25 basis points a rate increase every single time will do. I mean, every cycle, the impact is different, isn't it?
Well, if you run in FERPUS, which Andy was a very important part of, FERPUS, the Fed's model of the U.S. economy, and you raise the Fed funds rate by 25 basis points, you get that the GDP will fall by 0.1. So the impact is relatively modest. But what's most important here is that this is really telling us that the communication challenge for the Fed is enormous, because the Fed does not want to disrupt financial markets. The Fed wants everything everything to be smooth. The economics textbook tells you that the business cycle moves very smoothly, and not like that. So if they can do anything to avoid any disruptions and any volatility, they will do everything in their power to communicate us clearly to prevent crashes, volatility to move around very quickly.
Can you remember the last time a major central banker said, as Yellen today, that fiscal policy may not be the answer at this point? That seems like a big deal because we've just been fiscal. We need it. I get that we're at a different point of the cycle, but that really is kind of a shift from the...
I fell out of my chair when she said that. I mean, for a long, long time in Europe, in Japan, in the US, the answer has always been more fiscal from the central banks. Now we are at full employment in the US, so the reason why she's saying we don't need it is that if you do fiscal expansion when the unemployment rate is so low, then the main thing you get out of that is inflation. So it makes sense that she says it, but it is absolutely a regime change from the way that central banks have been talking about things for a long time.
Maybe I could just interject here, because the Congressional Budget Office has credibility, you know, as an expertise. They don't think we're at full employment yet. They think roughly, broad numbers, that we're about 1 million full-time jobs short of full employment. And my own assessments with Danny Blanchbauer, who's my colleague at Dartmouth, are along similar lines. When you look at the part-time workers who want full-time jobs, when you look at the employment ratio of females, 45 to 54, that's still way below where it was pre-crisis. It was very flat during the early 2000s. It's come down. It hasn't come all the way back. So there is some evidence that there's still significant slack in the labor market. Again, as Bill Gross noted, we know the unemployment rate is not a sufficient statistic. And so the case for having accommodative monetary policy over the next couple of years, maybe with some moderate amount of fiscal stimulus that helps bring those people back out of the sidelines into the workforce, is important for the economy. It's important for American society that we accomplish that.
All right. Our thanks to Deutsche Bank Securities' Torsten Slok and Andrew Levin, a former special advisor to Ben Bernanke and Janet Yellen. Fantastic to get both of your perspectives on a pretty big day for the Federal Reserve.
Coming up, President-elect Donald Trump met today with some of the biggest titans from Silicon Valley. We get a live update from Trump Tower. Next, this is Bloomberg. Silicon Valley leaders were among President-elect Donald Trump's most outspoken opponents during the presidential campaign. Well, this afternoon, they met with the president-elect face-to-face for the first time since November 8th. Apple's Tim Cook, Facebook's Sheryl Sandberg, Amazon's Jeff Bezos among those attending, representing really a who's who of U.S. tech's most valuable companies. Bloomberg technology reporter Selena Wong joins us now live from Trump Tower, where the meeting has just wrapped. Selena, we named a couple of the people who attended, but there were some that were not in attendance as well, notably Jack Dorsey of Twitter. Tell us more about the composition of the tech leaders who attended.
There was a pretty broad range of executives that attended. As you said, Twitter's Jack Dorsey was not there. Neither was Uber CEO or Airbnb's, although their press people said that that was because they were actually traveling. I did see many executives enter the building to go up to the towers. One of them was Safra Catz, Oracle's co-chief executive officer, and she said that she was looking ahead of the meeting. She said she was looking forward to it, that she was looking forward to discussing very important trade deals. And at the meeting, Trump actually struck a very conciliatory tone. He actually said that he was very proud of the innovations of the sector, that he planned to work with them together, that he was there to help them. Take a listen now to what he had to say.
I'm here to help you folks do well. And you're doing well right now, and I'm very honored by the bounce. They're all talking about the bounce, so right now everybody in the zone has to like me at least a little bit.
Selena.
So there he said it. He said he was there to help.
Sorry, yeah, Selena, so there are some complicated issues that directly affect tech companies. Obviously, immigration is one. They're very concerned about high-skill immigration. Also, for the hardware companies that have complex global supply chains, the ability to trade freely throughout the world is important for them. Are these areas where they're going to be able to find common ground?
Definitely. I mean, it's unclear from the meeting if they even got to those really thorny issues. But as you said on immigration, Trump has really flip-flopped on these H-1B visas, which is very important for Silicon Valley. They really need these high-skilled tech workers to be able to come into the country. You mentioned foreign trade. Trump has said today that he was going to try to make deals easier. But on the campaign trail, he's made many comments that has really alarmed the tech industry, such as even inciting a trade war with China if necessary. Another area that's they've also been in disagreement is cybersecurity. And so we just have to wait and see. After this meeting, there's going to be another follow-on one with Musk and Cook, and we'll have to wait and see what will come out of that.
All right, Bloomberg technology reporter Selena Wong outside of Trump Tower. Thank you very much.
Coming up next, we're going to be speaking with Dan Fuss, the legendary bond investor, about the fixed income market. Torsten Slok was just telling us Godot is coming for the fixed income market. This is Bloomberg.
Elisa Parenti. Let's get to the first word news this afternoon. President-elect Donald Trump's team says he is receiving formal intelligence briefings 3 times a week. They say Trump is also meeting daily with incoming National Security Advisor Michael Flynn to be briefed on intelligence matters. Trump recently said he doesn't need to hear the same information every day. He says he's told intelligence officials to let him know if situations change. And also, more than 4 million people signed up for Affordable Care Act plans for the first 6 weeks of the 2017 period. Government officials say that's for the 39 states that use the federal healthcare.gov marketplace and includes 1.1 million new customers and 2.9 million renewals through December 10th. President-elect Donald Trump has said he wants to repeal and replace President Obama's healthcare legislation. The U.S. is accusing 2 former Heritage Pharmaceuticals executives of colluding with generic drug companies to fix prices. According to court filings, ex-CEO Jeffrey Glazer and Jason Malik, a former president, were charged in Philadelphia. Now, they're the first criminal charges stemming from a 2-year investigation. The antitrust probe is said to span more than a dozen companies and about 24 drugs. China appears to have installed anti-aircraft and anti-missile systems on all 7 artificial islands in the South China Sea. That is according to a report by Asia Maritime Transparency Initiative. The group says the information is based on new satellite images. The findings come despite statements by Beijing that it has no intention to militarize the islands in the strategic trade route. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Scarlett?
Thank you so much, Elisa. Let's get a recap of today's market action. The Federal Reserve raised interest rates for the first time this year. Stocks promptly declined. The Dow Jones Industrial Average losing 118 points. The losses did moderate in the final half hour of trading. 19,792 was the final print. The S&P 500 losing 0.8%. All the sectors except for healthcare ended up declining.
Yeah, and the really brutal ones, those bond proxies, because the bond market got slammed with rates rising. For a deeper look into how the fixed income market is reacting to today's Fed decision and the election and everything else, let's bring in Dan Fuss, Loomis Sales and Company Vice Chairman. We've seen a pretty extraordinary move today, but also over the last several weeks. Does this have more to run?
Well, I think so. It's probably an adjustment upwards in the entire yield curve. It hasn't been all that severe, but it's moving up. Nothing extraordinary.
How much further could we see, say, 10-year rates go to over the next several weeks or months?
Several weeks or months, I'm not so sure. We're coming into the year-end adjustment right now, and that'll dominate. After that, depends on what the next move for the Fed looks like. It's too early to tell that. The fact that dot plots lead you to 3 increases, well, dot plots always overestimate. So you have to back off from that. And the Fed's going to watch what's happening. I don't think they've got their hands tied one way or the other. I'd be very surprised if they reversed. I think that's out of the question, probably. But their concern is not the U.S. economy. If the U.S. economy were the entire thing, then you could start to look for certainly 2, maybe 3 increases.
Now, in terms of where you see Treasuries headed, Joe has pointed out several times that the backup in yields didn't just happen right after the election. It actually started in late August.
Right.
I know you've weathered the rout in bonds fairly well. Tell us how you adjusted your portfolio, what you've been doing, and what you're doing now.
Apart from panic?
Yes.
Apart from that. Okay. Well,
always a word you want to hear.
Right. We actually cut the average maturity on the Loomis Sales Bond Fund, the biggest of the funds, in half a while back, gradually over a period of time. We'll stay right about there. What we've done is we've built into the portfolio what's known as a yield curve ride. Sort of a mechanical thing. Let the passage of time help you. It's getting easier. We're into a situation now where there are a lot of bonds that have been issued in the past that are selling at discounts and far fewer that are selling at premiums. That's a different bond market than a year ago. Very, very different, and allows for different strategies. It doesn't mean turnover goes up a lot. It doesn't. But with the passage of time, a 5-year bond becomes a 4-year bond,
right.
A different sort of bond. And when there's an adjustment up in rates, then you have another compensation going, and you can start to do what's known as riding the yield curve, more common with municipal portfolios than anywhere else. You can do it in corporates as well, and the higher rates go, the easier that gets. And the mechanics of the market are important, and what we have to bear in mind this time is we don't have a market that's anywhere near as liquid in corporates as it was, say, 10 years ago. So that's both a hindrance and an advantage. It's an advantage to the investment manager, but overall it's a hindrance to the efficiency of the markets.
Explain that a little bit more. How do you take advantage of the declining liquidity in the corporate bond market?
Well, as long as it doesn't go away completely.
Sure.
As it lessens, but let me put it this way, the middle of the market used to be like this, back up 10 years. And even 8 years ago, like this, relative to the size of the market. Now it's like this. So selling punches through, pushes down, punches through. Buying does the same thing. The market does much more seesaw during short periods of time. We have the new factor with the ETFs coming in, looking for bids or looking for offers, and that sort of aggravates it. So somebody that is sitting there just not passive, but watching in the markets all the time, you wind up filling a role of providing bonds to the market when it desperately needs it, and vice versa.
I want to get your thoughts on one of the proposals floated by Steve Mnuchin, who's the Treasury Secretary nominee. They floated the idea of selling longer-dated treasuries to help cushion the effect of rising interest rates, to help fund presumably some of the fiscal spending projects that the Trump administration has in mind. If you come inside the Bloomberg here, this is the current repayment schedule of treasuries. The blue part of the bar is the bond principal. The yellow part of the bar is the interest. What do you think of this proposal to sell longer-dated treasuries, and would you be a buyer?
No, I would not be a buyer. I think it would be a wonderful thing if you could do it. I wish this had been put forward a year ago. Even now, I think it might work. You'd have to watch your size. Your target would be the liability matchers, and that's a limited market.
Well, if you won't buy it, who would buy it? Who would this appeal to?
It would appeal to somebody that wanted to match a long-term liability with a non-callable, high-quality, probably not very good marketability, but they want to match that. So anybody that is really, really constrained by the duration of their liabilities, it would be a little too long, I think, for the life companies. But some of the pension people definitely would go after it, and the foreign buyers might.
Oh.
Yeah, that's, when I first thought about it, I thought, oh, that wouldn't happen. Then I thought through and I said, oh, yes, it would. Not many of them. You'd have a limited market. And Treasury has resisted doing this. Steve's idea is a good idea. Where was Steve 2 years ago? Well, he wasn't the apparent Treasury Secretary. So, but it's a good idea if they can do it. Should they do it? Yes. If they could do the version of British consols, I'd do that. Make them perpetual at a low rate. This rate's still low enough. Would I be the buyer? No, I would not.
Big picture, you talked about how you've let the maturity of your portfolio come in a bit. Rates have been rising since the middle of the summer. Is this a cyclical upturn that's just going to be sort of like several other cyclical upturns we've seen on this long decline in interest rates over the last several decades? Or is this different in somehow?
Good question.
It's different. It's a cyclical thing in a rising rate environment, not in a declining rate environment. The underlying, the bottom in the market was July of 2012, if you're measuring at the shorter end of it. And as you get out to the long bond or even the 10-year, you can say, well, no, it was more recent than that. You had a long period of time, 4 or 5 years. And now we're into the rising rate environment. How long? We'll see. How far? We'll see. We don't know. Right now you're dealing with the cycle. And what is so different than the last times we were in this setting is that our central bank's concerns are now very much international, constrained by a domestic mandate, but concerned with the world at large, because what's happening now, the dollar's popping up, and we have higher rates. So what happens to inflows, outflows? The money comes in. What about the people that's leaving? They need it, and it's leaving. That's the problem our central bank has. And so if you say prayers at night, do that.
That is my plan for tonight. Dan Fuss, Loomis Sales and Company Vice Chairman, thank you very much.
Thank you. Thanks for having me.
We've got some breaking news. Shares of Mondelez jumping in after-hours trading. This is on a report, a German bi-weekly business magazine, Bilanz, reporting that the global snack giant may be acquired by Kraft Heinz, which, as you know, is backed by Warren Buffett's Berkshire Hathaway as well as 3G Capital. The magazine, Bilanz, reported on the possible takeover, citing a person it did not identify. Again, an almost 10% jump in Mondelez in after-hours trading. Coming up, Mark Chandler, Brown Brothers Harriman Global Head of Market Strategy and FX, will give us his take on today's interest rate increase and what it means for the dollar. This is Bloomberg.
$500 million.
The Bloomberg Dollar Index set a record high after Janet Yellen and the Fed signaled a steeper path for borrowing costs in 2017 after raising rates for the first time this year. For more on the FX market, let's bring in Mark Chandler, Brown Brothers Harriman Global Head of Market Strategy and Foreign Exchange. Mark, thanks for joining us. So what's the big thing? What's your number one takeaway from today's Fed meeting?
Today's Fed meeting, I think it just reinforces my sense of divergence between U.S. monetary policy, and just last week the ECB indicated easing policy further by buying more bonds for longer. So this divergence, and to tell you the truth, it's not just about the U.S. two-year today, but the German two-year fell to record lows.
So massive divergence.
Big divergence. This is why I'm still a big dollar bull. I think that we have to get past, of course, there's a lot of uncertainty about the next administration. What is fiscal policy? How does it really shape out? But I think that the divergence of monetary policy alone, and then when we get into next year, there's at least 3, maybe as many as 5 European elections next year, and each one of those, a populist, nationalist person could win, theoretically at least.
But each time that happens, you would expect there to be less of a market impact. I mean, we had Brexit, which certainly shocked everyone, but by the time we got the Italian referendum, it was Was it even a shrug? Barely.
Yeah, I think that partly because the Italian referendum, the defeat of the referendum is not really like Juncker said today, defeat of the referendum is not necessarily an anti-European vote. But I think that the next one probably is the Dutch. They'll have an election in the first part of next year. The populist party's ahead. So I think that's really the focus. And I think that it's different in continental Europe because what's kept us at peace, what's kept our generation from having to go to war, is that there's been integration and sort of a weakening of nationalism. What we're seeing is a rise of nationalism, and that's the globalization, the integration is the glue that holds Europe together. So this populism is like an acid that's weakening the bonds that hold Europe together.
All right, let's talk about something a little less heady than the rise of nationalism and perhaps going to war again. This rates move that we've seen, this dollar move, is this just a cyclical thing? I asked this in the last segment to Dan Fuss, but how big is this in the big picture? Is this like represent a real break in sort of policy, or is this just an upward tick in rates?
Well, for me, I think that it's an important shift. And you look at the magnitude of the differentials now,
yeah.
like historic, whether you look at the U.S., UK, U.S. and Germany, U.S. and Canada, very wide. And so I think that this is, in the big picture, I think this is the third big dollar rally we've had since the end of Bretton Woods. Right. And before this dollar rally is over, and I think I called it the Obama dollar rally, but maybe it's the Obama/Trump dollar rally, I think the euro is going to go back down to test its historic lows from 2000, which is about 82 cents, which puts the dollar index at about 120. And I think we're at like a 101, 102 today. And so I'm talking about a big move over the next 2 years while the policy divergence plays itself out and the political divergence plays itself out.
How much is this dollar rally going to set back Donald Trump's administration's goal of getting to 4% GDP and the Fed's goal of 3 rate increases next year?
Yeah, I think you're right. I think that for me, it's not so much the level of the dollar, but the pace of it. And the pace has quickened since the election. But I'm not sure that we should count on this to be like just a straight line up. That there's going to be, we're going to get more details about the fiscal stimulus. We're going to find out that maybe some Republicans in Congress differ from the Republicans in the White House. We'll find that maybe the Democrats are not so eager to sign on to big tax cuts. So I think we have to play this out. But I think the general broad direction, even if the Fed only does 2 next year, it's at a little bit faster pace. We're getting closer to full employment. We're getting closer to the Fed's target, while Europe and Japan are still, maybe not light years, but still quite a distance away. So I think that's got more room to play. And so maybe we don't go 4%. It's tough for me to see. I mean, the Fed's forecast today, I don't think they show a dot plot above 2.5%.
So what happens when it does become apparent, or if it does become apparent, that maybe this fiscal stimulus isn't all it's cracked up to be? Maybe it's a lot focused on rich people and their tax cuts, and they're not going to spend a lot of that. How does the market react if that becomes the story?
Yeah, well, so the market's, it's really about positioning then. So the market's got this big positioning on where they are very long U.S. dollars. You can see this in the futures market. You can see this in every day almost. It's very short, shallow dollar pullbacks. So then I think we get a decent-sized correction, that these kind of disappointments lead to a counter-trend move that could last like we had in the first half of this year, where the Federal Reserve raised rates in December, and the dollar doesn't really find a bottom until May or June.
But how long, the big picture, you're talking about this third great bull market since the end of the Bretton Woods system, the euro perhaps going back down to the 80s. How many years does this play out? Like when's your time?
Yeah, I'm thinking another couple of years. I think that we have still room to go on the monetary side before even the ECB can even consider changing policy. And it's hard to tell what the BOJ is doing because last night they were big buyers of the very long end. So they're still easing policy. And I think this is what I think that is very hard for people to get their heads around is how could Europe and Japan be in such bad shape and the U.S. doing so well? And so in
this interconnected world.
Yeah, exactly. And so this divergence, I think, is not just on interest rates, but it's economies, it's health of the banking system. So I think it's got a ways to play out.
And that convergence will rear its ugly head also with Asian economies opening up to much weaker currencies because of that stronger dollar, too.
Exactly.
All right, Mark Chandler, thank you so much. Brown Brothers Harriman Global Head of Market Strategy and Foreign Exchange. Coming up, President-elect Donald Trump met today with some of the biggest titans from Silicon Valley. We'll discuss and show you the names. This is Bloomberg.
going back to President-elect Trump's meeting with tech leaders. Bloomberg technology anchor Emily Chang just got additional details from a person briefed on the meeting. Emily joins us now from San Francisco. Emily, what did you find out about this meeting?
Hey there, Joe. Yes, just got off the phone with a source who was briefed on this meeting, who said the meeting was very friendly and very productive. There were no real points of tension, which is interesting, given, of course, how vocal Silicon Valley had been against Donald Trump's election. The top three topics that came up: number one, jobs; number two, immigration; number three, China. There were a few subtopics. They did touch on infrastructure, education, repatriation of foreign capital. As we know, looking at the remarks from Trump himself, the meeting started off very flattering of the people who were in the room, the fact that they run, quote unquote, monster companies. But the reality is they can start off on this foot, but they still disagree on, really big issues, whether it is immigration or net neutrality or encryption or a range of social issues. That said, he did indicate that he wants to do everything possible to help them when it comes to trade, for example. Trump can certainly help when it comes to tax rates and the repatriation of capital. So this is an interesting first step, and at least it seems they're getting off on the right foot, if you will, but a lot remains to be seen.
And of course, Donald Trump's favorite social media tool is Twitter, but Twitter was not in attendance at this meeting. What's the backstory there?
Yeah, interesting. We just saw a headline from Reuters that says the Trump team says Twitter wasn't big enough for this meeting. Politico has also been reporting that Trump's team was not happy with the way Twitter and Jack Dorsey personally handled an issue with a crooked Hillary emoji that the team wanted to use on the platform. This isn't something that we've independently confirmed, but one thing that I can say is that Jack Dorsey in particular hasn't been shy about sharing his political views on Twitter. He did a Periscope with Edward Snowden yesterday. Peter Thiel, also, who really is responsible for gathering a lot of the folks at this meeting, hasn't been particularly fond of Twitter as well. In fact, the motto of his founders fund, his venture capital firm, is that they want something more innovative than 140 characters. Wow. So something there that we'll definitely continue to watch.
You probably never guessed that you would talk about a story with tension of the president involving a failed deal to establish a crooked Hillary emoji, did you?
Not at all. And the irony is, look, Donald Trump has used Twitter to great effect throughout his campaign. He uses it several times a day. He's obviously very fond of the platform itself. But, certainly interesting to think about how politics could potentially intervene in the business of Twitter. We're going to be talking a little bit more about that coming up on Bloomberg Tech.
All right. Thank you so much, Emily Chang. Bloomberg Tech anchor Emily Chang joining us from San Francisco.
And coming up, what you need to know for tomorrow's trading day. This is Bloomberg.
What'd you miss? The Federal Reserve finally raised interest rates this year. Stocks fell, the dollar rose, bonds declined, and yields spiked.
Pretty much everything fell, particularly short-term bonds, a really big move higher on the 2-year. But across the curve, that post-election, post-summer story of higher rates continues after today's decision.
Yeah, that certainly persists. As for tomorrow, we're looking ahead because the central bank decision moment is not over. The Bank of England will make its decision on interest rates tomorrow at 7 a.m. Eastern Time.
So much central bank activity. I'll be looking at economic data tomorrow when we get initial jobless claims. They've been very low at 8:30 a.m. Eastern Time.
And, of course, speaking of central banks, we also have the Bank of Mexico rate decision. That comes out at 2 p.m. Banxico is the preferred nomenclature for Bank of Mexico and what happens there. We'll be keeping an eye on that one and break it to you live.
That's all for What You Missed. Thanks for watching.
Have a great evening. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your Bloomberg First Word News. Syrian rebels say a ceasefire deal for the evacuation of fighters and civilians from eastern Aleppo is back on, hours after it collapsed. Spokesman for 3 rebel groups said the ceasefire would go into effect tonight, and implementation of the deal would begin early Thursday. President-elect Donald Trump's team says he gets formal intelligence briefings 3 times a week. They say Trump is also meeting daily with incoming National Security Advisor Michael Flynn. Trump recently said he doesn't need to hear the same information every day. He says he's told intelligence officials to let him know if the situations change. More than 4 million people signed up for Obamacare plans for the first 6 weeks of the 2017 period. Officials say that doesn't include sign-ups in states that run their own exchanges, such as California and New York. And a U.S. study of pregnant women with Zika finds that 6% resulted in birth defects. The rate was nearly twice as high for women infected early in pregnancy. The study was published by the Journal of the American Medical Association. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti. This is Bloomberg. Bloomberg Technology is next.
And this is Bloomberg Technology. Coming up, they are among Donald Trump's most outspoken critics, but big tech leaders just came face-to-face with the president-elect. We've got the latest from Trump's tech summit. Plus, in a unanimous decision, the Fed raises interest rates, and Janet Yellen says there's more to come. We'll find out what it means for tech. And Chinese app maker Meitu prices its IPO at the low end of the range, but it could still be Hong Kong's biggest tech listing in almost a decade. First, we've got some developing news to report. New numbers coming out of a new hack attack on Yahoo. Yahoo saying this hack is separate from the hack that they reported back in September, that this one in particular affected more than 1 billion accounts. Some of the information that was stolen, usernames, email addresses, telephone numbers, numbers, birthdays, passwords. Yahoo is working on finding the source of this intrusion. They believe that it is related to the state-sponsored hacker that was potentially involved in the earlier attack that they reported in September. They're taking steps to secure these accounts right now. They're notifying affected users. They're recommending that people change their passwords. This is quickly developing. We're going to keep on following this story and talk about it a little bit more later in the show. But again, another massive hack attack being disclosed by Yahoo affecting more than 1 billion users. I do want to get to the meeting at Trump Tower today. President-elect Trump just wrapping up a big summit with tech industry leaders, including Vice President-elect Mike Pence and tech advisor Peter Thiel sitting by his side.
I'm here to help you folks do well. And you're doing well right now, and I'm very honored by the bounce. They're all talking about the bounce, so right now everybody in the Zoom has to like me at least a little bit.
Apple's Tim Cook, Facebook's Sheryl Sandberg, Amazon's Jeff Bezos were all in attendance. For the tech giants, this meeting was an attempt to persuade Trump to avoid policies that might hurt their companies, policies pertaining to immigration, internet security and regulation, and on government investment. Ahead of the meeting, Oracle co-CEO Safra Catz stressed, quote, "We are net exporters. Over 60% of our sales are overseas, so better trade deals are very much in our interest." Here with me in the studio, James Chakmak, analyst at Monness, Crespi & Hart, and joining us from outside Trump Tower, Selena Wang, our Bloomberg tech reporter. Now, I did speak to a source who was briefed on this meeting who said the top 3 topics were jobs, immigration, and China, that the meeting was very friendly, very productive. A few subtopics they addressed: infrastructure, education, repatriation of foreign capital. Selena, give us the rundown. I know you've seen all of these folks walk in and then walk out. They didn't really speak to reporters, but tell us what you've seen.
You're right. They didn't really speak to reporters. The lobby was flooded with reporters, with tourists watching. But we did get a little bit of a glimpse at the beginning of the meeting. And Trump, as you said, really tried to strike a really conciliatory tone. He started off the meeting by praising Peter Thiel as being an innovator. He praised Silicon Valley for how important they were, for all the innovations that they've been able to accomplish. He said, "I want you to keep on innovating. I'm here to help." Another thing he said that was interesting was he said, "Call me anytime, call my people anytime." He said, "We don't really have a formal chain of command here." So he really changed his tone compared to a lot of the public opposition that was very alarming on the campaign trail.
Certainly interesting, James, to see them starting off on this foot after Silicon Valley was very vocally against the election of Donald Trump, aside from Peter Thiel. You know, obviously it's nice to hear these things, I'm sure, but, you know, what are the real policy issues that they're going to be at odds on here?
Look, like you said, it's trade, immigration, net neutrality, and so forth.
And a variety of social issues.
Right, but there's a lot of people saying that this is an about face, you know, a little bit Romney-esque, you know, what the tech leaders are doing. But, you know, why is it such a bad thing, right, to open up the lines of communication? Because if you have a direct line to the president, which is somewhat of an unprecedented thing that we're seeing right now, you can start to influence the kind of things that you think are important for the tech community and important for the world, really, and job creation and whatnot. But at the same time, you can learn, you know, where he's coming from and have at least a dialogue to open up these conversations. And when you are dealing, you know, with, in that room was sitting $3 trillion worth of value, you know, across all of those tech companies. So, you know, when you're controlling this much of the economy, you know, you need to have it, because it's not just about the outsourcing of jobs. It's about how do you position America for the next stage of growth when automation and all these things are starting to take over.
At the same time, we're learning that Twitter was not invited.
Right.
Reuters is reporting that Trump's team said Twitter was too small. This after Donald Trump used Twitter to great effect throughout his campaign and continues to use it on a daily basis. Politico has also reported that the Trump campaign wasn't happy with the way Twitter handled a crooked Hillary emoji that Trump's campaign wanted to include in their Twitter buy. Do you have any concern, as someone who covers the company, that this could interfere with Twitter's business?
No, I don't think so. I mean, I met with them this week. You know, it's clear that they are, you know, adhering to their core philosophy that, you know, they have to be a platform for everyone.
That said, Jack Dorsey has not been shy about sharing his political views. I mean, a lot of these folks have not been shy about sharing his political views, but Jack Dorsey tweets his
Look,
political
it's in the
views
best interest of
all the
Twitter to
time.
maintain a relationship with Donald Trump, because you have that's the biggest sort of validation you can have, by having the president, talk to the world through your platform and no other platform. But at the same time, I think Jack not being invited is really not that big of a deal, because I mean it's about the companies that are really about the job creation. When you think about what Twitter contributes to the general economy and the global economy, it's to a much lesser extent what you see from the guys in the room.
On that note, the point has been made that while there's a lot of innovation happening in Silicon Valley, the tech community doesn't necessarily create a lot of jobs relative to the weight that it punches. There's a stat that Apple, Amazon, Microsoft, Facebook, Google together account for 600,000 jobs, whereas Walmart accounts for 1.5 million in the United States alone. And that Apple, even though Trump has called for them to bring jobs back to the United States, it's very unlikely. And anyway, a lot of that would be automated. So I just wonder if Trump and these companies can actually find common ground on this issue.
They have to, because even the jobs that are going overseas, they're starting to be the jobs that are disenfranchising the United States workers by outsourcing those jobs to China and India and whatnot, those jobs are starting to be automated. So we have to prepare for the next paradigm, of how does the public and the constituency of the United States, prepare itself, through education initiatives and partnering with the tech community, so that in the next 2.0 technology world, that they actually are able to work and contribute to society. Because right now, even the jobs that are going overseas will be taken over by robots. But on the Jack Dorsey note, though, it is interesting that Kanye was invited,
exactly.
but not Jack.
And they came down for a photo op. Selena, Uber CEO Travis Kalanick was not there. The company has said he is traveling. However, he was named to the Strategic and Policy Forum along with Elon Musk, along with IBM CEO Ginny Rometty. This in addition to a number of business leaders who are going to be advising Trump on how the private sector thinks about some of these issues. Is there anything more you can tell us about this particular meeting?
I think it's going to be unclear how important Uber's CEO and Tesla CEO are going to be to this strategic policy initiative. The people on that initiative are very wide-ranging, also includes Pepsi CEO. But I do think that Trump will probably be turning to them to talk about the future of transportation, the future of how technology and transportation are going to work together. So hopefully this will be a very good line of communication moving forward, but no further details on that at this time.
All right, Bloomberg Technology, Selena Wang, live from Trump Tower. James Chakmak, analyst at Monness, Crespi & Hart. Great to see you here in person, James. Thanks so much for stopping by. Still to come, net neutrality is one of the key policies that could be on the chopping block under President-elect Trump. We will focus on the future of the FCC with the former commissioner next. This is Bloomberg. the most important tech policy issues at stake under a Trump presidency is net neutrality. This is the rule that prevents internet providers like Comcast and Verizon from charging companies like Netflix and Google a fee to deliver their content at faster speeds. In the past, Trump has criticized net neutrality as a top-down power grab, and Republicans have expressed interest in rolling back the rules. With the changing of the guard in Washington, that is likely to happen. So far, the Senate has not reconfirmed Democratic Commissioner and net neutrality advocate Jessica Rosenworcel. Trump will also name a Republican replacement for Chairman Tom Wheeler, tipping the balance of power in favor of the ruling party. Joining us now from Washington, former FCC Commissioner Harold Furchtgott-Roth, who's just written about his hopes for the tech meeting in New York this week. So, Commissioner, we've gotten some details about what was discussed there: jobs, China, immigration. It was a friendly meeting, though we know that a lot of these tech leaders differ with Donald Trump on a number of policy issues. What do you make of the foot they have started on?
Well, I think it was an important meeting both for President-elect Trump and for the Silicon Valley executives. They both need each other. President Trump and the administration will have a very significant influence on the business prospects of corporations and the high-tech industry. And the high-tech industry accounts for a large share of economic growth in the United States. And this economy needs to grow much more rapidly in the years to come.
So let's talk a little bit about the sort of gap between Silicon Valley and Washington and how you expect this to play out. I mean, you've said that the Trump administration isn't going to do anything that would be financially disastrous, just that might threaten some of the social sensibilities of the folks in Silicon Valley. And yet, when it comes to net neutrality, for example, this is a policy that could dramatically impact their businesses, right?
No, actually, I don't think it would. I think it's in the interest of Silicon Valley companies to have what I would call symmetric regulation. What we've had in the past